Adams, Chief Equity Strategist at Bloomberg Intelligence via Zoom from New Jersey. From New Jersey to Atlanta, we go to check in with our Bloomberg News economics reporter, Steve Matthews, who was listening to Jay Powell this one day after he caught up with Raphael Bostic, president of the Federal Reserve Bank of Atlanta. Steve, so glad to have you here with Mike Regan and myself. The narrative of what we got from Jay Powell felt very similar to what we got from Raphael Bostic yesterday today. Add it all up for us.
Yeah, that's interesting, Carol, that you say that, because Bostic's point yesterday was that we might have to have higher peak rates to get inflation down, and that is exactly the point that Jay Powell made today. And in a way that was hawkish, although it was well understood by the markets, so perhaps it wasn't totally received that way. But it was fascinating to listen to Powell and the Q&A, which was kind of wide-ranging from, what do you do in your spare time, and play tennis or golf or whatever, and to his
to how much do you make?
Yeah, exactly. How much do you make? $190,000. And he thinks that's a fair price. Which as people were saying, well, if the Fed chief is making $190,000. Maybe some of the Wall Street executives are overpaid. So.
I was waiting for him to ask how much do you bench press. That's usually the next question in that line of conversation. Steve, there's a lot of conspiracy-minded people in the market who tend to assume the messages coming from various Fed speakers are coordinated. That perhaps Jay Powell did not get the market reaction he was hoping for after the FOMC, and called up Raphael and said, "Hey, can you do me a favor and walk this back a little bit for me?" Is it crazy to think that goes on, or do you think that's actually possible?
There was this big theory on Wall Street over the last couple of days that Powell was going to come across as being very hawkish because he was, received in the press conference as being unusually dovish when he may not have intended to be, which is like kind of a conspiracy theory. And Powell, by and large, said the same thing that he said last Wednesday, with the exception that we had the jobs data. And on the jobs data, his point was, this just underscores the point that I've been making for a while, that it's going to take longer to get the disinflation that we expect. That inflation is not going to come down in a smooth way like Wall Street expects and get to 2% by the end of the year. It's going to be choppy. It's going to be messy. There'll be ups and downs. And the fact that the job market is super strong is a reason that kind of underscores the fact that the path is going to take longer than people expect.
Hey, Steve, just got about a minute left here. So the key takeaway from Jay Powell, we know this is our most important conversation this week. What's the key takeaway for investors?
I think the key takeaway is that, I guess a couple of things. One, policy is very much data dependent. At one point over the last year, you knew that they were going to raise rates by 50 basis points, 75 basis points. They telegraphed it well. And now they're kind of reaching a point where they're nearing the end to get to a peak, but you don't know exactly where the peak is, and that may be uncomfortable for people. And that beyond when they get to the peak, they're going to be there a long time. The view of the Fed is this is not going to happen quickly. They're going to need to have rates at a restrictive level for a very long period of time.
There's the message, folks. It's not like it's new. We've been hearing this. Right. Steve, thank you so much. And a great interview yesterday with Mr. Bostic. Steve Matthews, of course, our economics reporter at Bloomberg News in our Atlanta bureau. Check him out on Twitter at Steve Matthews12. Check out his interview and story with Raphael, and certainly go back and listen to that conversation with Jay Powell. I loved how Abigail Doolittle mentioned it or described it, kind of a cat and mouse game.
That's always the case with a Fed interview. It's interesting.
But David Rubenstein certainly has a knack. It was really incredible. All right, you are listening and watching Bloomberg Business Week.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:21 on Wall Street. We check the markets all day long at Bloomberg, and a rebound in tech shares has put the broader market back in the green as traders assess Jay Powell's remarks. You heard him live being interviewed by David Rubenstein right here on Bloomberg Radio. The Fed chief said that if strong labor data persists, the peak rate in the current tightening cycle may be higher, while adding that it will take time for inflation to reach the central bank's target. Right now, we've got the 10-year yielding 3.66% with the 2-year at 4.45%. S&P up 18, higher by 0.4%. The Dow holding on to a 23-point gain, while NASDAQ is up 89, a gain of 0.7%. Spot gold up 0.2% right now. Gold 18.71 the ounce. West Texas Intermediate crude rallying 3.8%, 76.92 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with Mike Regan, in for Tim Stenovic here on Bloomberg Business Week, live in our Bloomberg Interactive Brokers studio, streaming on Bloomberg Originals and, of course, on YouTube. Okay, so we've all been obsessed, Mike, and preoccupied with all the layoffs coming from technology companies. I mean, it feels like almost daily. I mean, Zoom out today with some job cuts.
Yeah, absolutely. I mean, you add them all up, it's in the tens of thousands at this point. And yet you look at the macro data, the jobless claims, the unemployment rate. You know, the U.S. added 500,000 jobs last month. Something doesn't add up. So hopefully our guests can unpack it all for us.
Right, and we even had the Fed chief, Jay Powell, talk about strong labor data, you know, watching it, and if it persists, it means peak rate may be higher. We do have the perfect guest with us. Writing about the tech job cuts and what it means for the broader U.S. labor market is Chris Anstey. He's Bloomberg News senior editor. He joins us via Zoom in our Boston bureau. Chris, good to have you here with us.
Good afternoon.
So much to talk about because I know you were on the live blog following Jay Powell today. First up, though, let's talk about the labor market. It does feel like with these tech job cuts that it feels really badly. Put it into perspective for us.
Yeah, so the concern is, do these tech giants, and as Mike was indicating here, it really is pretty much all of them, right? We've had Amazon, Microsoft, we've had Alphabet, the Google parent, Dell just earlier this week, IBM. All of them have been coming out with thousands and thousands of layoffs. And the question is, do they know something that the rest of the economy doesn't? Are they kind of the leading edge here of a broader slowdown in the labor market and in the economy? And it's kind of interesting. So the Goldman Sachs economics team kind of dug into these and took a look at, okay, what's prompting this? And they had a couple of interesting points. First of all, besides most of these companies being in the tech sector, they have a couple of other similarities. Many of them took on a lot of jobs during the pandemic. In fact, if you average it out, they saw a 41% surge in their headcount over the pandemic. By contrast, the rest of the economy only up about 2%. So the idea is they overloaded during the pandemic. They've also seen a bigger sell-off in their stock prices than everybody else. Their share prices are down 43% on average from peak levels, and what the market as a whole, I think, from peak to trough was a little over 20%. So the idea is they're under pressure by investors to deal with costs. They overloaded on payrolls, and they aren't necessarily representative of the broader state of the economy.
You know, Chris, at the same time, we often hear about how other companies outside of the big mega cap tech companies have had a hard time finding that tech talent, you know, the programmers and whatnot. And that makes me wonder why, with all these layoffs, that those macro numbers, the jobless claims, unemployment rate, aren't really moving. Is it possible, you know, you get laid off from Google or Microsoft and you immediately find a job at a startup or even a bank if you're a programmer? Or is it just impossible to tell exactly what's going on?
Well, that's an interesting point because that's something else that the Goldman Sachs team looked into. And they said, there's not an abundance of evidence here, but they're picking up on signs that indeed people are able to turn around and get a new job pretty quickly. We had the job opening numbers for December just a few days ago, and across the economy, there's still 11 million job openings, unfilled jobs. There are questions about, are the jobs as high paying as the previous ones, but there's a lot of turnover. There's still plenty of opportunity out there. And for now, as we heard from Jay Powell earlier today, the job market has not turned.
Well, and the other thing too, Chris, I think about is this labor hoarding. We hear it from various CEOs. I mean, it sounds kind of funny, but it's a real thing.
There was an interesting tidbit in the labor report back on Friday. So we were all reporting, the seasonally adjusted numbers. So the 570,000 increase in payrolls is, seasonally adjusted. January raw data, in January, the economy always sheds jobs. People are laid off. But what really happened was there were fewer layoffs than usual for January. And that's why the seasonally adjusted number jumped up. So that adds to the idea that people are hoarding workers. They were not laying off as many as they usually do because they know it's going to be hard to find people down the road.
Chris, you talk about how these big tech companies really went on a hiring binge during the pandemic when everyone was stuck at home and on the internet. The flip side of that, obviously, was that leisure and hospitality category. There's still a lot of ground to be made up in that sector, right? I mean, is it possible that that's taking up some of the slack here?
Yeah, for sure. That still hasn't come back to the peak level. Another one that is important to keep in mind is healthcare as well. All those hospitals, saw people leave, nursing jobs, especially the frontline jobs, cleaning the rooms and doing that kind of thing. Really difficult, very intense, kind of high pressure jobs during the pandemic, and those are not yet back to their peak. So again, you have to wonder if people lose their current role in another field, do they go back to filling those jobs that are still out there?
Yeah, we did hear from, we've been talking to various folks in the restaurant industry, heads of restaurant chains and companies, and they say that they're finding a lot of their workers are going elsewhere. Those workers that were with them pre-pandemic, whether it was, serving tables, doing different things, they found jobs elsewhere and maybe traded up, if you will, in terms of income and so on and so forth. The one thing, Chris, I do want to say that just jumped out at me in your story is the ADP research that said tech companies represent about 2% of all employment. That compares with something like 11% in the leisure and hospitality sector. Tech is such a big part of the publicly traded markets, and I think it's kind of interesting to have it put in perspective in terms of employment.
Yeah, for sure. I mean, you also have to think that going forward, even if some of the giants, effectively overhired during the pandemic, tech is going to be an area that sees persistent strength. If you think about, broader demographic trends, we're not seeing fertility rates, as high as they used to be. We're not seeing immigration as it used to be. So there's going to be more and more focus on automation, on the deployment of technology as a labor-saving tool. So you have to figure that that's a growth industry over the long haul.
Chris, you mentioned that 11 million job openings in the JOLT survey. I mean, that's off the charts compared to pre-pandemic. What do you think's going on there? Why are there still so many job openings in this country?
Well, I think part of it is, the lack of immigration. Economists estimated that we basically had something like a 2 million, hole, 2 million missing immigrants that did not arrive during the pandemic when everything was locked down. Actually, it even started before then with the Trump administration starting to tighten some of the immigration rules. So we didn't see, as many tech workers coming in from India, for example, the so-called H-1B visas. So we have, a number of openings that might have been taken from by immigrants over the past few years. Immigration is starting to tick up. We actually heard that from Chair Powell earlier today.
Right.
But it's going to be hard. You're never going to make up those 2 million.
Hey, listen, 30 seconds left. We'd be remiss because you were on the live blog listening to Jay Powell. What was your takeaway? And just quickly, Chris, if you could.
I'm not sure that he necessarily meant to be more hawkish than he was last week. It might have just been the way the question and answers transpired. But I did think it was interesting that he said that the debt path is unsustainable. You can bet that Republicans are going to be picking up on that.
Yeah, absolutely. Hey, listen, thank you so much. I think a really important story when it comes to understanding what's going on in the labor market. Chris, thank you so much. Chris is Bloomberg News senior editor, joining us via Zoom in Boston. Chris Anstey there joining us. I do think it's an important story because I think sometimes, Mike, we see these headlines about job cuts and it feels really severe, and yet you've got to look at the whole labor market.
Yeah, still a hot market out there.
All right, let's get a check on world and national news. Off to Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. President Biden is putting the finishing touches on his State of the Union address. The White House says he'll highlight accomplishments from his first 2 years and also chart a vision for the year ahead. That includes a call for a minimum tax on billionaires and quadrupling the levy on stock buybacks. Terry Haynes, founder of Pangea Policy, says they will not fly in a divided Congress.
He's going to focus on proposing things that are red meat for the base, like stock buybacks and the like, that won't get enacted, as opposed to things that might be enactable.
Terry Haynes with Pangea Policy. The president is also expected to address the war in Ukraine and police reform following the killing of Tyree Nichols. Well, the White House has put out First Lady Jill Biden's guest list for the State of the Union. Bloomberg's Nathan Hager has details on that.
The list includes Ukraine's ambassador to the U.S., the family of Tyree Nichols, former House Speaker Nancy Pelosi's husband, Paul, who's recovered from a violent attack inside his home, and the lead singer of U2, Bono. The White House says the more than dozen guests of the First Lady personify issues and policies that the president will bring up in his speech. Inviting the Nichols family suggests the president will call for action on police reform. Bono is being recognized for his work with PEPFAR, the global AIDS relief effort unveiled at the State of the Union 20 years ago by former President George W. Bush. In Washington, I'm Nathan Hager, Bloomberg Radio.
You can catch full coverage of the State of the Union on a special edition of Bloomberg's Balance of Power. It begins at 8:30 p.m. Wall Street time on Bloomberg Radio and television. SpaceX founder and CEO Elon Musk wants to launch the company's Starship prototype into orbit next month. He tweeted the first orbital test of the vehicle would happen once a few remaining tests are completed. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:41 on Wall Street. I'm Charlie Pelletan. We check the markets all day long at Bloomberg, and we have got Fed Chair Jay Powell delivering a message for Wall Street. And that message, central bank is not done tightening. With more, here's Bloomberg's Vinny Del Giudice.
In the wake of December's strong employment data, Powell signaled the Fed still has plenty of work to do, and the central bank's terminal interest rate may be higher than markets have anticipated. Powell spoke at the Economic Club of Washington.
We think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time.
The Fed chair has argued that easing pressure in the labor market is a way to subdue inflation. Vinny Del Giudice, Bloomberg Radio.
Indeed, a rebound in tech stocks has put the broader market back in the green as traders assess Jay Powell's remarks. Now, as Powell spoke, we had stocks pushing higher. A few minutes later, stocks moved lower. Now they have rebounded back in the green. S&P up 30, up by about 0.7%. The Dow up 0.3% right now, up 116. Nasdaq up by 1.1%. 10-year yield 3.66%. The 2-year 4.44%. Spot gold up $6 the ounce now to $18.73, up 0.3%. West Texas Intermediate crude up 4.1% right now, surging $3.07 a barrel. WTI 77.17. Sources tell Bloomberg Credit Suisse Group is delaying a much-anticipated compensation day for some of its investment bankers, further straining its relationship with employees as it restructures its Wall Street operations. Shares of Credit Suisse Group, the ADR, is up by 2.1%. And Goldman Sachs has raised $5.2 billion for a private equity fund that will buy early-stage companies that are typically small in size. Goldman up now by about 0.7%. Recapping, stocks move higher. S&P up 30, up by 0.7. And that is a Bloomberg Business Flash.
All right, got it. Charlie, thank you so much. Charlie Pellet there. Well, big activism. It is back. Why? Well, some rule changes and a fatigue with bad corporate governance playing important roles. But as with so many things, it starts with money and good timing. So writes Bloomberg News senior deals reporter Ed Hammond in a story in the upcoming issue of Bloomberg Businessweek magazine, out on newsstands later this week, already on the Bloomberg terminal and online at bloomberg.com/businessweek. Ed Hammond, as we mentioned, deals reporter. He joins us on the phone in New York City, along with the editor of Bloomberg Businessweek, Joel Weber. He's in our Bloomberg Interactive Brokers studio. It does feel like all of a sudden the activists, Joel, have kind of awakened.
Yeah, and it got quiet there for a little bit, right? And then you can only lick your chops for so long before like let's do this. So Ed, what did the targets look like, and why did it go quiet for a little while?
It went quiet for several reasons, and obviously we try and get into all of them a little bit in the article. I think first and foremost, it was just very expensive for activists to go after big companies until the recent turn in the stock market, which has obviously brought valuations down a fair bit and just made building that initial stake easier. It also obviously gives them quite a lot more potential upside if share prices are sort of off their all-time highs. But I think there are other things at play here as well. I think the changes in the way activists, and indeed anyone, is allowed to sort of vote in terms of nominating directors is significant. The so-called universal proxy rules, which allow dissident shareholders to put forth their nominees for the board of directors on the same card that the company has to send out to shareholders. Now, that seems very technical, but it actually is a meaningful change for activists because it both lowers the cost and the workload needed to actually elect directors to go onto public company boards.
So what was the name when it popped that you were like, okay, we're back in the game?
I think Salesforce was the one for us that really kind of highlighted the trend. I mean, they say that three make a trend, and Salesforce got 4 activists in the space of, a few days, which is pretty unheard of. I mean, occasionally you see 1 or 2 showing up in very large companies, but for 4 big brand activists in the form of ValueAct and Starboard, Elliott and Jeff Ubben to all show their hand, it's pretty significant and shows us that big companies are obviously back on the table, but there's obviously also enough appetite among the activists to really go for it.
Ed, when I was reading your story, it made me start to wonder, you think of the famous activist investors out there: Nelson Peltz, Paul Singer,
Gordon
Carl
Gecko.
Icahn.
No, just kidding.
But of that era, that's what it
that
leads
ilk,
me to believe.
right?
These are all investors who have been around for decades now, and it makes me wonder, is there a new generation coming up behind them, or is this kind of a lost art to some degree? I know there's a lot of younger investors on the activist short side, but is activist long? Is it sort of an old-fashioned thing, or are there no one?
It's a great point. I mean, it's a sort of gentocracy of sorts, this kind of investing. Just wait 2 minutes. And the reason it's so fun to cover is, as you say, these are sort of larger-than-life characters who have been around for several generations and through lots and lots of market cycles. And they're fun. I mean, they say things that are interesting. They say things that are not the sort of pre-prepared speech that we might expect from a lot of investors in today's market. And they make it much more entertaining to cover. In terms of new entrants, yes, there are lots of new small activists, but they tend to be less well-financed, so it's much harder for them to come into these kind of big companies that we care about. They also tend to come in with a sort of a smaller, if you like, menu of options that they can push. So they'll come in often to small companies and say, look, just sell yourself because you could get a control premium that might be 40% above where you are now, and we want that bump.
Hey, Ed, you mentioned the SEC, the new SEC rules in terms of the board. How much of that, would we be having this conversation with you, do you think, if that hadn't happened?
I think it adds to the ability of activists to do these kind of things. I think we probably would be seeing some large-scale activism. I mean, obviously it paused a bit during COVID, and so there's this sort of money on the sidelines that was waiting to be deployed. You couple that with the fact that valuations have come in a lot, and you get that sort of inevitable uplift in activism. But I think, yes, the rule changes have definitely made it easier. I think Peltz himself, when he came out against Disney earlier this year, was very clear on that point, that the universal proxy rules had in some way facilitated his campaign, and actually was something he had lobbied quite hard to get introduced.
Okay, so Ed, what do you think it's going to look like? What's the, ultimately there's exits that these investors are looking for, but when are they willing to sort of settle, and what is it? How does that trajectory play out for what's in store still?
So I think usually activists want some form of control, and that's more often than not in the form of a board seat or, getting one of their sort of independent people nominated to the board of directors. In very big companies, I mean, yes, it's possible to do that, and they often do achieve that, but it's usually minority slates as opposed to whole control slates.
Well, what do you see happening at Disney, Ed? Are they going to gain some traction?
That's the one that I'm most excited about,
Yeah.
right? It's just like, you can't imagine sort of a bigger fight. And to have Iger leading the company and having this happen while he's there, I'm sure he must be...
This is before we even bring in Ron DeSantis into the mix.
Exactly.
What do you see happening with Disney?
Look, it's such a fantastic fight, Peltz versus Disney. I mean, you can't really make it up in terms of the characters involved and the sort of the iconicness of the company. Look, Peltz at this point only really wants one thing, which is a board seat. He doesn't want anyone to get fired. He doesn't want buybacks. He doesn't want any of the normal leaders. He just says, put me on the board. I will make this a better company. He's used his track record at P&G and Heinz Kraft to sort of show that actually he is a good director and he does add value. Disney have pushed back and said, no, you don't understand the media. You don't understand the sort of modern issues facing a multimedia company like Disney. So they're declining. Now, Brian are a big investor in the company, so they do have real skin in the game. They do have, a reasonable case that they've made in terms of the value of their investment coming way down. Whether or not Peltz actually wins this fight to get on the board, it will remain to be seen. Usually, in a situation like this, the target company would sort of settle somewhere in the middle. Now, that might be putting Peltz on the board for a period of time. It might be giving him a sort of observer role where he doesn't have real active control on the board, or it might be putting on a third party that both Disney and Peltz can agree on.
Well, we're going to find out more because Disney has scheduled April 3rd an annual meeting for that showdown with Mr. Peltz. So unless maybe there's something sooner that comes out. We'll see.
Yeah, stay tuned.
All right, Ed Hammond, thank you so much. Deals reporter at Bloomberg News on the phone in New York City. Jill Weber, the editor of Bloomberg Business Week here in studio. This story, as we mentioned, in the upcoming new issue of Bloomberg Business Week out later this week, already on the Bloomberg and at Bloomberg.com. This is Bloomberg Radio.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 2:53 right now on Wall Street. See an ad for food on TV, and you've got to have it now. DoorDash and streaming platform Roku are teaming up to allow viewers to order meals and snacks from ads. And with more on the story, more on the technology, here's Bloomberg's Denise Pellegrini.
Charlie, under this new deal, restaurants will be able to run interactive ads directly on Roku. And the streaming service says this deal lets advertisers find a household and user that's no longer on traditional TV. Also, these streamers apparently like to relax around mealtime. 1 in 3 users use takeout or food delivery once a week or more. And Roku users will also get a 6-month DoorDash membership for free. And Wendy's will be the first DoorDash brand partner offering special discounts. And this Roku DoorDash deal, we should point out, also being strategically announced just before Super Bowl Sunday. Charlie.
And that's Denise Pellegrini. Roku shares, they're down now by 0.6%, but DoorDash shares, they are higher by about 0.3%. Microsoft has unveiled a version of its Bing internet search engine powered by the newest technology from ChatGPT maker OpenAI, seeking to gain ground on Google by offering an artificial intelligence-based service that generates more conversational answers. Microsoft up now by 4.1%. Boeing plans to trim about 2,000 finance and human resources jobs, part of an initiative to slim its corporate structure while bolstering the manufacturing workforce. Boeing up 2.8%. Those are our company stories. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
More Business Week coming up in just a moment.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
More Business Week coming up in just a moment. First up, a check on world and national news with Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. Search and rescue crews from overseas are deploying in Turkey a day after a pair of powerful earthquakes killed more than 7,000 people. The EU's Joseph Borrell commends those who've rushed to the scene.
We have to remember the victims and the brave rescue workers who are still working around the clock to find survivors.
EU High Commissioner Joseph Borrell. Turkey's defense ministry says the military has started evacuating some of the injured via Navy ships. Millions are suffering without power or heat in the bitter cold. President Biden delivers his State of the Union address tonight against the backdrop of two big issues: tensions with China rising, and then there's that brewing showdown with House Republicans over raising the debt limit. The president is expected to highlight the accomplishments of his first 2 years in office and lay out his vision for the next year. He will also outline a four-part unity agenda, areas where both parties can come together on things like cancer cures and veteran support. The House Oversight Committee is looking at the Biden administration's handling of the Mexican border with testimony from Chief Border Patrol agents from Arizona and Texas. We get more from Bloomberg's Irv Chapman.
Chairman James Comer opened the hearing. President Biden and his administration have created the worst border crisis in American history. Agent John Modlin described how well-organized smuggling cartels employ quasi-military tactics to bring in groups of young single men.
No one crosses the border in Tucson sector without going through the cartels. Everything south of the border is controlled by the cartels.
Committee Democrats noted that their last spending bill added 300 Border Patrol agents, and they urged Republicans to support immigration reform. In Washington, Irv Chapman, Bloomberg Radio.
Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Mike.
All right, appreciate that, Nance. Thank you so much. Well, Bloomberg Business Week, we are brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. In about 8 minutes, you can find out if your business qualifies for employment retention credit assistance. Innovation Refunds has helped thousands of small to medium-sized businesses claim the ERC and may be able to help yours as well. Time is running out to claim the ERC, so get started today. Learn more at getrefunds.com. Well, as you know, February is Black History Month. Every day this month, we are celebrating significant moments in U.S. Black history. So now with your installment for this Tuesday, February 7th, let's bring in Bloomberg's Justin Milliner. Hi, Justin.
Hey, Carol. Thank you very much. On this day in Black history in 1926, the precursor to Black History Month was celebrated for the first time. Now, in its initial form, it was just 1 week, and it was the brainchild of noted historian, journalist, and author Dr. Carter G. Woodson. He was nicknamed the father of Black history. Dr. Woodson's life work was the pursuit of education, particularly helping Black people learn more about their history. He was born in Virginia in 1875 to parents that were former slaves and illiterate. And he was in an area that didn't have many good options for school, but despite all of that, he taught himself most common school subjects, graduating high school in just 2 years by the time he was 20. From there, he became the second Black American to attend Harvard University and receive a PhD. Throughout his scholastic pursuits, he realized there was a lack of interest in Black history, so he dedicated his life to changing that. He created the Association for the Study of Negro Life and History in 1915, and by 1926, Dr. Woodson launched Negro History Week on the second week of February, chosen to coincide with the birthdays of both President Abraham Lincoln and Frederick Douglass. Each February, his legacy lives on with Black History Month. And that's today in Black History, Carol.
All right, truly appreciate it. Justin Milner, thank you so much.
Thank you.
Here in our Interactive Brokers studio. All right, in just a few minutes, Mike and I are going to head over to our TV colleagues, talk a little bit about the markets. We're calling it the round trip when it comes to stocks and bonds. I mean, bonds are pretty much, the yields are back to where they were before Fed Chief started speaking.
Well, now they're round tripping the other way in the equity market back up. Who knows?
Oh my God, the only thing we can count on is volatility, that's for sure. All right, folks, countdown to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close with 60 minutes left in the trading session. Kriti Gupta and Vonnie Quinn joined now by our colleagues Carol Masser and Mike Regan in for Tim Stanovic. Together, we welcome our full Bloomberg audiences across television, radio, and YouTube. Carol, what a day and what a trade.
Yeah, I love what Lisa Bromowitz said earlier on television about this kind of round trip when it comes to certainly yields, because yields are pretty much back where they were before those comments from Jay Powell. Stocks, rallied, sold off, and then, kind of shot up again. So let me just take you to one sector that we did see kind of that outperformance stay even through the comments by Jay Powell, and that has to do with the cruise line specifically, courtesy of Royal Caribbean leading the rally after forecasting record 2023 adjusted EBITDA, saying too that it's seeing a record-breaking wave season, which is a booking period that begins in January, lasts through March. So Royal Caribbean, it's up 7%, Carnival's up 2%, and you've got Norwegian up about 4%. The hotels index overall, which includes those cruise lines, Mike, up about 0.8%.
Carol, something I find fascinating today is look at the leadership elsewhere in the market. We've got the NASDAQ Composite really leading the way up 1.5%, 15% on the year. And this despite the fact that we didn't see a real big sustainable drop in yields from Chairman Powell's comments today. So I wonder, Kriti, is the narrative going to shift this year away from tech being so rate sensitive to more of a margin story? Remember, these companies are laying off tens of thousands of workers. Maybe investors are latching on to the idea that they're cutting cost, protecting those margins, and tech, Kriti, perhaps will be a little less rate sensitive this year.
Yeah, and I think it's a really good point because to all of that kind of cost efficiency story, the layoffs that the stock market has been rewarding those shares for, that's what's been driving not just the gains in tech, but the gains broadly in some of the benchmarks. In fact, we should get a check on the major benchmarks here. The S&P 500 higher by over 1%, up 1.1%. The Dow up 203 points, higher on a percentage basis by about 0.6%. But you can really see the outperformance Mike is talking about with the NASDAQ higher by about 1.5%. And to me, when the NASDAQ and the Russell move in tandem, that is a signal of breadth. The Russell 2000 higher by 0.3%. Vonnie, that is to me the relationship that I'm going to be watching.
Well, it's another nice 1% for the NASDAQ, which had given back a couple of percent the last couple of sessions. You have to wonder if this isn't interrupted now at this point. Take a look into the subsectors, and you can see consumer staples are lower today. Really not by that much, but they're the ones that leading the declines. The energy index obviously up 2.7%. That's thanks to oil rallying today. We're in fact above $80 for Brent, not above $80 for crude for WTI yet, but certainly up in the 77, 78 range. And then earnings, of course, investors really rewarding those companies that do beat or give outlook that's not as bad as anticipated. The gamers, for example, it was a real mixed bag this time around, but investors are really rewarding the likes of Take-Two Interactive and Activision Blizzard.
Yeah, and that's something that you're going to see across the board as well, that idea of rewarding the stock market. Folks, there are some movers you should keep an eye on. I'm going to start with the negative here. The Bed Bath & Beyond story is fascinating, down 47%. It was dealing with a volatility halt earlier this morning, and this, of course, coming after their $1 billion capital raise plan, something that investors and analysts alike are saying, look, even if you do raise this money, which, of course, they do have investors standing by, it still won't be enough to sustainably move the stock and perhaps save the business, creating a little bit of negative sentiment around that stock. 310 on those shares, down about 47%. But the rest is green on the screen. It really comes back down to that tech story because Baidu really getting the kind of miracle touch or the Midas touch of the ChatGPT story, surging after affirming that the ChatGPT-like bot is going to launch in March. And of course, we saw what that did to Alphabet and Microsoft shares earlier this year. And Zoom, once again, a cost efficiency story, rallying by about 8%, cutting 1,300 jobs as their CEO reduces pay pay and forfeits those bonuses, something being rewarded by the stock market. And we got to push it forward to after the bell because we are getting Chipotle earnings, and it looks like people are a little bit bullish, up about 0.7%. But I want to take you to a terminal chart here because it actually really comes down to the Federal Reserve. We're still waiting for that switch into earnings driving the macro trade, and right now, terminal rate still pricing in 50 basis points of hikes, Carol.
Well, according to Fed Chief Jay Powell, we're going to have more interest rate increases. I've got to say, this conversation between Jay Powell and David Rubenstein, of course, co-founder of Carlyle Group. He, of course, hosts the show here on Bloomberg TV. They were at the Economic Club of Washington. They covered a lot of ground. We've kind of strung together a couple of the highlights of that conversation. Listen up, everybody.
We're just at the beginning of this process. The disinflationary process, the process of getting inflation down, has begun. It has a long way to go. These are the very early stages of disinflation. It's not going to be, we don't think, smooth. It's probably going to be bumpy. This process is likely to take quite a bit of time. My guess is it will take certainly into not just this year, but next year to get down close to 2%. We think that we're going to need to do further rate increases, keep rates at a restrictive level for, for a period of time. The base case is for me is that it will take some time, and we'll have to do more rate increases, and then we'll have to look around to see whether we've done enough.
Of course, that is Fed Chair Jay Powell talking exclusively with David Rubenstein of the Carlyle Group. And what's interesting, too, is I think, the key takeaways, Mike, is that he's saying policy is data dependent. We've heard that a million times from the Fed officials, generally, that we're nearing an end, but that peak might be a little bit higher. And we're not quite exactly sure where it is. But once we get there, Mike, we're going to stay there for a while.
Yeah, Carol, and he's made it clear over and over again that they really expect to keep rates at that level for quite some time, in his words. And yet, if you look at the Fed funds futures, they're still pricing in about 50 basis points of cuts by January of next year. So, Vani, regardless of what Jay Powell says, the market cannot shake this conviction that the Fed's going to cut this year by the second half of the year.
You have to wonder if at some point we're not in for a radical repricing and very quickly. And Mike, you also have to wonder what's happening here because the Fed chair says one thing and then Fed board presidents go out and say something that's maybe slightly different. So is the Fed chair taking one angle and letting the deputies do more of that kind of work?
Yeah, it really comes down to then what does that actually mean for the markets when at a rare moment, I have to say, in the last 3 years, the stock market and the bond market, Mike, are on the same page. And that to me is really striking. Both markets, both asset classes, pricing in the cuts that you were just talking about.
Yeah, and you know what else is analysts pricing in some cuts in the earnings estimates. We're now looking at negative year-over-year earnings growth for the S&P 500. So how that gets you an 8% gain year-to-date, Carol, how that could be sustainable, I don't know.
Well, one thing I want to say is we checked in with Gina Martin Adams earlier, and she thought what was interesting is to see tech rally. It makes no sense, especially if the expectations, as we clearly heard from Jay Powell, that we are going to have higher rates from here, and it makes no sense to see tech rally. So somebody's got to be right, and I guess over time we will certainly see. I feel like that dot plot come March becomes even more important, if you will. All right, guys, that's a wrap. We'll continue our cross-platform coverage on the markets. We'll be back in less than an hour's time. Radio, TV, YouTube, and of course on Bloomberg Originals. We will count you down to the close with Beyond the Bell at 4 p.m. Wall Street time.
Thank you very much, oh Mr. Roboto, for doing what I asked, oh Mr. Wants to, and thank you very much, oh Mr. Roboto, for helping me escape to Mr.
All right, everybody, we'll be back with our TV colleagues. We'll count you down to the close as we've got a rally underway, at least with equities. Hey, one thing that we've been talking a lot about, robots, and I think this all has to come with so much attention being paid once again on artificial intelligence. We're going to talk about that in regards to Microsoft a little bit later on, but we're just talking about robots getting smarter, what it means for our jobs, what it means for our world at large. And so we did want to get into it because a certain Bloomberg opinion column definitely caught our attention. Let's bring in Beth Kowit. She is someone who covers corporate America for us here at Bloomberg Opinion specifically, and she's here in our Bloomberg Interactive Brokers studio. Beth, I do feel like all of a sudden AI, artificial intelligence, it's the new world's it girl, if you will. And so now we're like, oh my God, what's going to happen to our world? In terms of the corporate world, AI is already a big part of what goes on.
Absolutely, and we've seen this for a long time in human resources already, right?
AI is part of training, it's part of recruiting, it's part of hiring. So I think
How? Explain to us how that is.
well, for example, if you submit a resume, you might have a company might have a system where it goes through and finds keywords. So if you have those keywords, you get passed on to the next level. So we've already seen it sort of infiltrate parts of the process.
Well, I'm picturing this Arnold Schwarzenegger Terminator coming to fire me here, Beth. But how would it work? Would it be a similar type of thing? Just somehow the AI is able to assess your performance better than a human, or assess more employees in bulk better than an HR manager could?
Yeah, I mean, I think we have to be careful here. I don't think, an HR manager is going to push a button and out will come the pink slips, right? I think it's going to be a similar thing where it will scan and maybe do a first pass, and then a human will hopefully make the decisions. Of course, I'm sure some companies will try to rely solely on AI and algorithms. I'm not sure that's the best idea.
I have to say, when I was reading through your story, one thing I thought about when I did a deep dive on UPS a few years back, excuse me, and I went out with the driver, and they're inputting data, picking up packages, delivering packages. I mean, there's a lot of information about that individual's day in terms of how productive they were. And I do wonder, Amazon's using it, as you highlight in your story, like how that data could potentially be used in terms of assessing the value, the value of a worker.
I mean, that's a really good point. Hourly workers have already been managed algorithmically for a long time. I think what we're seeing now is
in terms of output and stuff,
right? I think we're seeing a shift now to office workers, right? We have so much more data on how people perform, their keystrokes, their mouse clicks, and I think that the data wasn't there before.
How many
now
stories a journalist writes?
Right, all that too.
Carol.
Sorry. Keep going.
Yeah, but I do think now that the data is there, it's going to start feeding into some of these automated decisions.
I'm on the radio. That's why I'm not writing stories today, right? If my boss if any robots are listening, that's my story. I'm sticking with it. But Beth, I picture investors out there thinking, all right, AI is coming into HR. How do I invest in that? Are there sort of third-party software companies? Will it be a Google, a ChatGPT? Is there anyone sort of taking the lead as a vendor for this type of product yet?
Well, it's interesting because I do think that the forefront of this is going to be tech companies, right? They're already using it. I think a lot of them have their own technology. One thing is, I don't think a lot of companies really want to talk about this. It comes across as the kind of callous, and so I do think it's
surveillance almost.
It is,
right. And there will be pushback from employees. We're going to see that eventually if we haven't already. So I think that there is going to be caution and wariness here about talking about it.
It's like with hedge funds that use AI too. It's like Fight Club. The first rule of AI is you don't talk
Don't
talk about how you're using it. You don't want to tip your hand, I guess.
No, it's a really good point. And what kind of advantages, I guess, it potentially gives who's ever using it. You guys, in your story, Beth, you include a few surveys about what HR leaders say they will use it for. Is there some kind of big takeaway?
Well, one of the big takeaways is something like 98% of HR leaders said that they will rely to some extent on software and algorithms if they're making labor cuts in a 2023 recession. So we know it's going to happen. The other stats that are kind of interesting is that they don't necessarily believe that it will make the right decisions. So they say they're going to use it, but they're a little bit hesitant. So I think that's something that we all need to keep in mind too.
Yeah, do you think there'll still always be some sort of human element involved? Maybe AI spits out 20 names that you could perhaps lay off, and then a human goes through and sorts through them.
There needs to be. I make the point in the column that human resources is about humans, and we need to keep that in mind. I mean, a layoff is one of the most traumatic things that can happen to a person, and it's kind of unfair to turn that decision completely over to the robots.
But I always think about, the filtering of data is only as good as the inputs of data. And this is we talk about it, I'm sure you do, the just concept of biasness in data that's put into whatever group of data points. And then your outcomes are going to be biased if the data is biased. So that's something that they've got to be thinking about.
Right. Bad data in, bad data out. And I think people might believe, oh, this is a fairer way to do it, right? This is just based strictly on numbers. But we know that AI has the potential to encode bias. We've seen a lot of examples of that. And I think we're not going to get rid of this problem, right? We have to be careful and wary of that.
Yeah, it's funny. I was talking to last week Matt Bartolini. He's works for Spiders, the ETF company, and they have an AI ETF that basically scours thousands of SEC filings, annual reports, proxies, whatever, looking for certain things. And he said there's a concern about companies starting to sort of game that process. Like they know what words the robots are looking for, and they'll start, inserting them into their earnings calls, into their statements. I wonder,
That's true.
I wonder when we get to that point where sort of the employee starts to, sort of get ahead of the AI. I guess we're, probably too early to say when that's coming. But do you think that's a factor at all?
Yeah, I do, and I think the bigger risk might be though the bias piece, right? What we just talked about. There's a really interesting example that a couple people pointed me to of Amazon trying to create a system where it could find job candidates that it felt were going to be the strongest, and it was based on historical job applications. Most of them, not surprisingly, we're talking tech, were from men. So the system penalized women who applied for jobs. I think that this is,
Wait, how did it penalize them?
Because it was looking at past applications. It saw that most of them were from men. So when it was kind of calculating going forward, it was like most of our successful job candidates have been male.
Oh, interesting.
And so
Okay.
women were penalized as part of the process.
But just speaking to what you just said, Mike, like you think about it in the future, like when someone is filling out a digital jobs application, do they put certain keywords in there to trigger, being caught up in a job search, if you will, at a company?
I bet that's already happening. I bet that's already happening.
You can put your name as Carl Messer.
Right.
Oh my God, that reminds me of grade school when people would, substitute teachers would call me Carl and I'd be like devastated. How do you think about AI more broadly in terms of the workforce? Because I do think, or just the work environment, I think we're all jumping on it and thinking about kind of those dystopian movies that are crazy, but I love that you remind us, like, we've been using it for a long time. Mike, as you say, the investment space has been using AI. So how do you think we have to be smart about it when we kind of throw this term around?
Yeah, I think that there is a misunderstanding about what AI is, what it can do. And one of the things I liked about this example, this column, is that I do think there are some things that only humans can do. And it's part of that interaction. Again, the workforce is a human thing. We don't always know how our decisions are going to play out long term. Human intuition still plays a role.
Well, and it seems like, AI's been around for a while now. Companies are using it in various functions, but this whole ChatGPT thing really seems to have accelerated the conversation. It seems like this
you think so, Mike?
just a little bit, But it just seems like such a leap in innovation almost overnight. Do you think that's a misperception? Is it, just the fact that this thing launched, but really, it's not as big of a leap of innovation as it looks like?
No, I think it is a big leap, and I think that is why we are talking about this so much. Somehow I managed to not mention that in my column. I should get points for that, but I do think that people, if it hasn't been on your radar yet, I think it is now. And I do think we're going to see people closely watching what's next.
Well, it's the deep fakes. Like there's all of a sudden a lot of reporting on that. Like just this ability to make things look so realistic in our world and how it could be misconstrued or just false information getting out there.
Right. No, I agree.
So, robot pink slips, are they coming?
Hopefully not.
I'm stealing a term from our Ariagami who was saying it. Wait, is that just around the corner, robotic pink slips? Beth, really appreciate talking to you because it really just fits into this bigger, broader conversation we're having. Beth Kowit, she is senior columnist at Bloomberg Opinion. You can check her out on Twitter and also check her out at Bloomberg.com and on the Bloomberg for a little bit more on her column. No, it's funny though, technology data in investing has been around for a long time.
Yeah, absolutely. Like I said, though, you don't always know exactly how it's being deployed. So,
But it's their secret sauce, right?
If ChatGPT can write some radio scripts, Carol, I don't know. Might be in trouble.
I'm in for it. I can be an editor rather than a writer. All right, folks, you are listening and watching Bloomberg Business Week right here on Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. I'm Charlie Pellet. We have got the Dow, the S&P, and NASDAQ trading close to session highs. So let's head right over to the first word breaking news desk for today's afternoon call. And here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks choppy after Powell's comments, but trading back in the green. Dow's currently up 184 points. S&P's gained 42, and NASDAQ is up by 178. The U.S. 10-year yield at 3.67%. Gold is up 2. Oil is also climbing, and Bitcoin is higher by 0.7%. Among the main 11 S&P sectors, the leaders were energy and technology, while consumer discretionary and consumer staples were under pressure. Leaders to the upside in the Dow, Microsoft, Boeing, and Chevron, while Verizon fell 2% and led to the downside. In other news, Zoom announced a 15% cut in its global workforce, and Powell says he expects 2023 to be a year of significant inflation decline. Wrapping things up, some of the names reporting after the bell tonight include Chipotle, Prudential, and Vertex. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg, type Squawk, SQUA on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet there. Well, keeping a watch on shares of Microsoft, folks. They are up about 4%. The company's CEO, Satya Nadella, saying it's a new day in search. That at an event at Microsoft headquarters in Redmond, Washington, a little bit earlier today. We are all in on everything to do, it feels like, with artificial intelligence. So let's get to it with Bloomberg Technology co-host Ed Ludlow. He's out there in San Francisco, our 960 studio. Let's start there, Ed. It does feel like just add AI, onto the end of a statement, onto the end of a ticker, end of a company, and everybody gets excited. But yeah. Microsoft's the real deal. They made a $10 billion investment. So what did we learn today?
Well, it feels like February 6th through February 7th was the day that global technology woke up and was like, we should probably announce what it is that we're doing. Everything's happening at once. I would point out that, Microsoft shares are moving pretty much in lockstep with this S&P 500. And we knew this was going to come. A Bloomberg source had told us a week ago that the next step in the relationship between Microsoft and OpenAI was to take that underlying technology, the large language models that power ChatGPT, and add that technology to Bing search. And they've demonstrated what that looks like. So Bing is a tiny proportion of the global search market, which is dominated by Google, right? It's about 9% when it comes to Microsoft's Bing. And historically, if you just type in a question, it gives you a list of web links. And what executives were doing on stage was giving us examples of how using this AI from OpenAI can actually vastly improve the search experience. And that could give Microsoft some advantage, or at least push back against Google's dominance in this market.
Well, and Google, too, out this week, right, Ed, with an announcement about their AI product, Bard. I get the impression that Google sort of got caught on the wrong foot by ChatGPT. Are they sort of rushing to catch up here? Or is this a matter of something they had in the works and it just wasn't ready for prime time, and now they're ready to talk about it? How do you see the development of this product?
That's your phraseology is so funny, because I was going to say, when you compare Google, it's them dipping their toe. So feet analogies all round. The thing about Alphabet and Google, and this has been quite well reported, Google dominates the market for search. But when you think about YouTube, when you think about maps, there's just more data at stake. And so it's been more conservative and cautious to take what it's been working on for years and years in the realm of artificial intelligence and roll it into a commercial product. Simply put, and according to comments Satya Nadella made to staff internally, there's just more at stake, there's more risk. So they're being a bit more careful. Microsoft has to play catch up, right, in the realm of search. And yes, it's put its money where its mouth is in terms of the investment, a reported $10 billion into OpenAI. But I think that's very much the right assessment, Mike, that Microsoft is kind of going all in right now, while Alphabet holding its cards closer to its chest, dipping its toe, because they know that they have billions of users, right, for all of their products across search, maps, YouTube, etc. There's more at stake if they get something wrong.
How will this impact the user? I mean, is this a dramatic change, Ed?
It is actually. Let me give you the example that Microsoft gave. So if you go into Bing's search engine, which is powered by the AI now, the new version, and you ask it, I'm planning to go on a trip with my wife for our anniversary, leaving from London, I want to find somewhere within 3 hours flight. Rather than just generating loads of web links, actually the example that Microsoft gave is the AI gives you options. So if you like beaches and sunshine, it will give you a paragraph suggesting Malaga in Spain. If you're more into the mountains and you're more into lakes, it will suggest Annecy in France and give you a bit of information about that. If you're more into art, culture, history, then the AI will spit out Florence in Italy. This is kind of next level search return. It makes it more conversational, like ChatGPT does, and gives you more substantive search results, which Microsoft's hoping makes it a more attractive search tool relative to a Google search.
You know, Ed, all this reminds me of a few years ago when companies would just add the word blockchain to their name. You know, the
Yes.
Long Island Iced Tea Company became, I think, Long Island Blockchain or something like that. You know, do you think that's where we're headed, in that every tech company out there is going to try to sort of get in on this AI story? Or is it really just the Googles and the Microsofts of the world that can compete at this level?
I think that's a very interesting question. Microsoft has moved astonishingly fast. If you think about the story a bit more holistically, ChatGPT came out in November of last year, and within a week, OpenAI had reported it had 1 million users. Fast forward to just the last 10 days, ChatGPT has already launched its own subscription tier, whereas any user can pay a premium to access premium tools, whether you're a software developer or just an AI enthusiast. And in that period, Microsoft, which already had a partnership with OpenAI, right? They invested $1 billion back in 2019. They've now boosted that relationship. We assume that they've just kind of worked on this in the last few weeks, but it's probably the case. It's been over a number of years. They've already integrated the underlying algorithms into their Azure cloud platform, and they've made it go into the real world relatively quickly. The conversations we have on the Bloomberg Technology Show speak to the idea that actually this technology has and is more ready than perhaps we thought it was for real-world deployment. But I would point out to you guys, in parallel, conversations around the ethical concerns and the safety concerns are also happening. It's just that everyone's moving forward. And by the way, the venture capitalists say there are lots of tiny startups out there that are just as well positioned to ride this wave as the mega cap tech companies.
Well, you took me right to my next question, Ed, and that is something that I've been following the last couple of days, last week or so, is all of these kind of smaller players in the AI space, whether it's SoundHound, which is now up about 93% so far this year, and a lot of it, I feel like in the last week or so. You've got C3 AI, it's up 110%. How are we supposed to, as investors, what are you hearing about how we view them? Are these companies that can be taken out, that are going to combine, or what?
This is the $1 to $10 to $50 billion question. I mean, it's a lot of fun every day to come in and use whichever function you like to use. I like to use COMP on the Bloomberg terminal and do year to date. Big Bear AI is up 640% year to date. It was up 800%, but it's trimmed some of those gains. And the market's trying to position itself to kind of speculate what the next big player will be, with many of these companies not having commercial use cases to show for it. The message I'm hearing, and this is anecdotal, particularly from VCs that have invested in AI technology for a long time, is that bigger is not necessarily better. Microsoft has made an astonishing financial bet on OpenAI, $10 billion. But the counter argument is actually, how do they use it? Google's advantage is it has a wider range of data that are simply not available on the open web. It's specific to them. It's proprietary. That might give them an advantage. It's not anything to do with how much they've invested or how they've relied on the third party or whatever. So I think everyone is trying to work out those that are sort of tangible and have promise versus the many VCs who say 100 pitch decks cross my desk a week. 90% of them say I am AI related, and 89% of that 90% have nothing to do with AI whatsoever. It's a bubble, as Mike was alluding to, and so the skill is to find what's the next viable name. And I'm not the one to do that. I just come on and talk about the mad moves.
Well, I wanted to ask you about that VC element of it, Ed, because for a few years there, it seemed like Web3, crypto was really a hot focus for VC. Do you think this is all enough to cause a pivot to fund more AI projects and sort of turn their back on Web3?
Yeah, I would say if you take OpenAI as an example, it has a relatively long history for Silicon Valley. It was founded in 2015 in San Francisco. Sam Altman, who leads it, still there, but remember names like Reid Hoffman, Elon Musk were involved in those very early days. Venture capitalists recognized a broad range of potential capabilities that AI can use in automation, data processing and analysis that would replace human or manual functions. And so investment firms have been running for a long time. The big names with billions of dollars in deployable capital, and very niche thematic firms that only invest in AI. They've been around for a long time. That's not necessarily a new trend.
But you do wonder, right? You know, Google is the behemoth, right, when it comes to search. Yes. But could possibly Microsoft, being younger, nimbler perhaps, whether or not they can make some inroads in here, just quickly?
Yeah, so plug. We have Youssef Mehdi, the vice president of Microsoft, on the show tonight, 5 p.m. Eastern. I'm asking him exactly that. Does this literally mean you take market share from Google? That's what we want to know. It's all well and good investing and announcing, but what's the point of it for Microsoft? If they actually say they can pull it off, I think that would be interesting to investors, tangible market share gains.
Not apples to apples, but Intel versus AMD. I'm just going to put it out there in terms of kind of what's going on. Look forward to that interview, and always look forward to when Ed Ludlow joins us. He's co-host of Bloomberg Technology at Bloomberg News from our 960 studio in San Francisco. Catch him on Bloomberg Technology tonight at 5 p.m. Wall Street time. All right, right now it is time for a check on world and national news. Off to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is ready to offer a reassuring assessment of the nation's condition in his second State of the Union address tonight. House Minority Leader Hakeem Jeffries says Biden has a strong record to stand on.
We're going to build upon our track record of success and continue to fight for lower costs, for better paying jobs, for safer communities, to make sure we stand up for middle-class Americans.
Republican Congressman Steve Scalise is countering Jeffries' rosy view.
He may talk tonight about the debt ceiling, and of course, the debt ceiling is a symptom of Washington's spending problem under Joe Biden.
Scalise says President Biden's policies are leading to a weak economy. Tomorrow, House Republicans plan to kick off their investigation into the Biden family and its financial dealings. The House Oversight Committee plans to focus on Hunter Biden's laptop, something that's been at the center of GOP attention since the 2020 presidential campaign. Recent polling, though, by the Pew Research Center shows 65% of Americans are concerned Republicans will focus too much on investigating the Biden administration. We could be close to finding out whether Donald Trump will be the first former president to face criminal charges. As Bloomberg's Nathan Hager reports, the decision could come at the state level.
Fulton County, Georgia District Attorney Fani Willis says her decision is imminent on whether to indict the former president for interfering in the 2020 election. That's as the judge in the case is still weighing whether to make the special grand jury's report into that alleged interference public. Willis's decision would have a ripple effect on the special counsel and other investigations circling the former president. Legal experts say there's nothing to stop a special counsel from pursuing federal charges, whatever the Georgia DA decides. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. I'm Charlie Pelletan. This update brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. There is still time to claim the Employee Retention Credit. Unlike the PPP, the ERC is not a loan. Business owners can use the ERC to expand their company, pay off debts, or hire new talent. The money is there to help your business as you see fit. Learn more at getrefunds.com. We check the markets all day long at Bloomberg, and right now, as we head toward the closing bell, we have got the Dow, the S&P, and NASDAQ at or near session highs. Right to the numbers, with the Dow up 230 points now, up by about 0.7%. S&P up 49, a gain of 1.2%. Tech the outperformer, with NASDAQ up 204, up 1.7%. NASDAQ 100 index up now by about 2%. 10-year yield, 3.67%. We have got the 2-year yielding 4.47%. So the Dow, the S&P, NASDAQ, all rallying. Gold, a little change now, up less than 0.1%. $18.69 the ounce, while West Texas Intermediate crude now surging by 4.3%, $77.31 a barrel. An up day with the Dow, the S&P, and NASDAQ all gaining. As for the overall interest rate outlook, Mona Mahajan is Senior Investment Strategist at Edward Jones.
Most people thought we had maybe one more 25 basis point rate hike in March. Now it looks like May is back on the table for an additional 25 basis point rate hike. And those rate hikes do act with a lag impact, as we've been saying for probably the last 12 months or so. And so probably what we're going to see is sometime in the first half or maybe, third quarter of 2023, we are going to see that slowdown kind of materialize in the economy.
And lots of earnings after the close of trading today. Some of the reports we'll be hearing from in roughly 18 minutes or so. NCR, H&R Block. We'll be hearing from Vertex Pharmaceuticals, Omnicom, VF Corp, and also reporting Chipotle Mexican Grill. Chipotle shares up now by 0.7%. And that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 minutes left in today's trading session. And I mean, talk about going around the world. Stocks were down. They rallied just as Fed Chief Jay Powell started speaking. Then they sold off, and then they've rallied. They're just about at or just off their best levels of the session. Charlie, of course, just breaking down the numbers. So let's get some thoughts on where we go from here and what the investment environment feels like. With us, Sarah Ponsek, financial advisor at UBS Private Wealth Management, a former Bloomberg colleague, joining us via Zoom in Fort Lauderdale, Florida. Hey, Sarah, good to have you here with Mike Regan and myself. So it was an interesting day. What do you make, first of all, of the equity reaction kind of around the world, if you will, post Jay Powell today?
I'm so happy to be here today with both of you, Carol and Mike. But stocks are liking to keep us all on our toes right now. I mean, like you said, they are really all over the place around the world, as you described it. But it's interesting because I'm sure you were listening in to Fed Chair Powell speaking with David Rubenstein. And what did he say that was new? Well, not really much at all. He continued his language in saying that disinflation has begun. He said that last week during his press conference. He also said that the Federal Reserve has more work to do. He also said that last week, and so did some of his Federal Reserve colleagues in other interviews this week. And he also reiterated that the jobs market is still strong. So sure, maybe some are pointing to the fact that he didn't push back or become too much more hawkish than he was last week. You could say he was a little bit more hawkish, but not quite too much more hawkish. So stocks are rallying, but the reality is, when we look at the rally that we've seen this year, it's been unbelievable. It's really taken a lot of people by surprise and by storm as well. But entering into the year, positioning was pretty light. And what that means is when you have investors who are wrong-footed, who have tried to de-risk, and all of a sudden they see a market just storming higher, they get FOMO, fear of missing out, and they start chasing the rally, which seems to be a lot of what's happened this year.
Yeah, Sarah, it strikes me it must be a difficult time to be a financial advisor when you have a moment like this, you know, FOMO erupting all over the place. You know, do you get an uptick of calls from customers saying, hey, you told me to be defensive this year. What's going on? Do I need to chase this? You know, how do you answer that call?
You know, so it's an interesting question, and I would say the last year has definitely been an interesting one, you know, in the world of financial advice. But, you know, all along, even if we did advise...
Interesting good or interesting bad, Sarah?
Both. I would say,
Okay.
you know, there have been some difficult times, but they're all learning experiences. And I would say, you know, it's also a learning experience for our clients, because when we say, okay, get a little bit more defensive, especially, you know, there's different scenarios. When you're talking to someone who's already fully invested, that didn't mean that we went to them and said, all right, you're going to sell all your stocks, you're going to go to cash, and we're going to time this thing, you know, 100% perfectly, and you're going to get in at the bottom 6 weeks ago, you're going to ride the rally. You know, instead it means, okay, you get a little bit more tactical. So maybe you shift your positioning within the equity market a little bit more defensively, but you don't cut your exposure, because the last thing you want to do is limit your upside exposure. You rather want to protect yourself on the downside. So, you know, for our clients who have largely remained invested, because, you know, we don't believe that timing the market is a truly, you know, feasible thing that many people can do over and over and repeatedly again. So they're happy this year. You know, bonds are up, stocks are up. It's been a great year so far.
Sarah,
but we have been warning them this might not last.
I got to jump in, because what do you say to clients as you say, you know, maybe it doesn't make sense to chase potentially some of these high flyers, but if I look at, you've got a Meta up 3%. We talked about Microsoft, and obviously they held an event today, I think up about 4%. Communication services, which include a lot of these big tech names, that is your second best performer among the major industry groups in the S&P 500 today. As our Gina Martin Adams said, it doesn't make sense. If the Fed is saying we're going to see higher rates, these are typically the type of stocks that get hurt in that higher rate environment. So when your clients say, hey, Sarah, but this is where the gains are this year, what do you say to them?
Well, an easy rebuttal to that is, sure, they might be up, you know, on a year-to-date basis, but how have they performed relative to other areas of the market over the past year? Because, you know, investors haven't just bought into their portfolios starting December 31st or January 1. You know, they've been holding these industries, sectors, stocks for a longer period of time, and you can see those are the areas that have been beaten down over a longer period of time. Now, to your point, when you see, you know, especially, you know, if you look at last year's market, 2022, and you look at your worst performers, and then you look at this year, it's just as though the entire market has been flipped on its head. We have seen the exact opposite. Your worst performers are this year high flyers, but in a way, you know, it reminds me of 2021, for example, before we actually saw the massive downturn last year, and we saw some of those, you know, pre-revenue, high-growth companies really take a large hit. Back then, everyone wanted to own those names. And people had talking for years and years, you know, well, for a while at least, saying, okay, crypto or these high-flying growth companies were going to take a hit, and no one believed you because they were just going higher and higher and higher. Now it does feel as though there's a different comfort level from investors and clients in the market, because if they had said that in 2021 and they wanted to hold on to those names, hold on to those industries, and then last year, you know, some of them were down 70, 80%, if not more. There's a little bit of a different feeling this year when you see them, you know, coming back, but not nearly recouping those losses.
You know, Sarah, the other big story at the start of the year is that we're seeing some very good strength from some of the overseas market, you know, the world ex-US. I'm not sure if that's something that's on the average investor's radar, if they're not staring at their screen all day like we do. But how are you talking about international stocks to your clients these days? And quickly, we only have about 30 seconds left.
Yeah, really only about 20.
I'll keep it quick. Well, really quickly, you're right. Home bias is absolutely an issue. You know, most U.S. investors only care about U.S. stocks, but people have been talking about valuation differentials for a long time. We're finally seeing that take hold with, you know, Europe, emerging markets taking off this year and outperforming the U.S. And we think it's definitely an interesting place to be, and we're bringing it up in conversations.
Yeah, it does feel like it's coming up more generally in conversations. Sarah Ponczak, thank you so much. Financial advisor at UBS Private Wealth Management, joining us via Zoom from Fort Lauderdale, Florida. This is Bloomberg.
company news headlines on Bloomberg Radio.
And it is 3:53 on Wall Street. I'm Charlie Pellet at Bloomberg World Headquarters. Microsoft has unveiled a version of its Bing Internet search engine powered by the newest technology from ChatGPT maker OpenAI, seeking to gain ground on Google by offering an artificial intelligence-based service that generates more conversational answers. Microsoft shares up now by about 4.5%. Hertz Global Holdings shares surged 6.7% today after earnings. Hertz ended last year with far fewer Tesla vehicles in its fleet than planned when the rental car company was plotting its late 2021 stock listing. And with more on that story, here's Bloomberg's Steve Rappaport.
Charlie, Hertz has far fewer Teslas on the road than it planned to order by now. Hertz says its rental fleet in the Americas peaked at 428,700 vehicles last year. 11% of its fleet were Teslas, and that means Hertz had fewer than 50,000 of the electric vehicles in its fleet, less than half the 100,000 the company said it would order by the end of 2022. Hertz's October 2021 announcement of its Tesla order sent the electric vehicle maker's valuation soaring past $1 trillion for the first time. Charlie?
And that's Steve Rappaport reporting. Today we've got Tesla shares up by 1.3%. Hertz, worth repeating, up by 7.6%. Boeing plans to trim about 2,000 finance and human resources jobs. Boeing up by 3.9%. Zoom Video eliminating 15% of its workers. That stock up 10.2%. Those are some of the company stories we're following. I'm Charlie Pellet. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, just a few minutes left in today's trading session. Charlie breaking down the trade. We're going to head over to our TV team, talk about the close, and we've also got some earnings coming out that we will break down for you. In the meantime, we wanted to get to, I'm Carol Master along with Mike Regan, we wanted to mention one of the most read stories, I think it's the second most read story on the Bloomberg in the past 8 hours. And Mike, this has to do what's going on with New York City suburbs. Few open houses drawing offers way over asking prices. So this is going to play into housing inflation again, I feel like.
Yeah, absolutely. And it's so surprising considering that mortgage rates have basically doubled over the last year. But I guess, you know, in one way that causes fewer people to sell their house because they don't know if they can afford the next upgrade to the house. So it really is sort of limiting the number of houses on the market in neighborhoods like this. And just some eye-popping numbers. This story talks about one house, somebody in the open house pointed out the hardwood floors were scratched. The refrigerator looked warped. A pair of the kitchen cabinet doors was missing. It still went for $2.3 million.
Is this the house in Scarsdale?
Yeah, Scarsdale, yeah.
Yeah, they said it was it's just outside, about 20 miles outside of Manhattan. Great schools, beautiful setting, and as you said, I guess it was listed for 1.93 and then went for 2.28. That's some nice
yeah.
upside, if you will.
Yeah, absolutely. I mean, and, you know, again, maybe New York City is an outlier, but it's just really surprising to see this. You know, given all of the concerns there are about weakness in the housing market this year with these higher rates.
Yeah, we'll see how much it kind of holds on to. I know that there was some, I'm trying to think whether it was Mike weighing in or somebody else weighing in or one of our guests, but just saying that the anticipation is that maybe housing prices will come down as we've started to see rents come down, so that ultimately it all kind of comes off. And I think mortgage rates have dropped back about 1% in the last.
Yeah, they've come off the high. And maybe that's getting people
so.
to really think, hey, now's the time to strike too. But I don't know. You got a house to sell, Carol?
Not yet. But although, you know, you look at stuff like this, it makes you certainly think twice about it. All right, you are listening and watching Bloomberg Business Week. Carol Master along with Mike Regan in for Tim Stenovec. We're going to head over to our TV colleagues, talk about the markets, because folks, just rolling over, but we are going to finish, it looks like, on the equity side of things, just off our best levels of the day. Tech, the NASDAQ, really an outperformer. Right now, just up about 1.9%. Time to head over to our TV team. Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day. Kriti Gupta and Bonnie Quinn counting you down to the closing bells, and here to help take us beyond the bell with a global simulcast. We're joined now by Carol Master and Mike Regan in for Tim Stenovec, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. Fascinating trade. We were here an hour ago, and we were kind of in mixed territory now. Decidedly green on the screen.
Yeah, no doubt about it. The risk on trade is on. You are right. Like, equity is right just off at their best levels of the session. I've been looking for some outperformance, and I'm finding it in the semiconductors. The SOX is up about 3.1% as we speak. Take a name like NVIDIA, that is up, I think, 4 or 5%. So we're really seeing investors move aggressively into, I feel like, a lot of the tech area, which we're seeing as a result of that NASDAQ moving higher.
Yeah, Carol, and it's fascinating because a pretty muted reaction in the bond market today. Looking at the 10-year yield, it's only up about 3 basis points at 3.67. 2-year yield is hardly moving, so it really seems like this FOMO is really directed squarely at the equity market, Vonnie, and the bond market's just kind of sitting on the sidelines and watching.
Yeah, we did get a little piece of information that might have incrementally also helped the mood here with U.S. consumer spending, borrowing rising in December by the smallest amount in nearly 2 years. Now, that reflects a step back in activity with credit cards and other types of loans. So whether that's a good thing or a bad thing, not maybe exactly obvious, but at the same time, it does mean that consumers have been using credit cards less, so there's less of a chance of delinquencies at least. So that might also be helping mood.
And of course, take a look at the, well, closing bells here. We are just under 10 seconds to the proper settlement. The S&P 500 higher by 1.3%, Carol. The NASDAQ higher by about 2% on the day as well. And the Dow Jones, 266, higher in the green.
Yeah, really interesting. The S&P is staying well above its 200-day moving average. If I dig a little bit deeper into the S&P 500, 350 names, Vonnie, in the index, ending up the day with gains, 152 to the downside, 1 unchanged. So you can see that certainly optimism feels like it's back in the equity market again.
Exactly. Enthusiasm even. The semis and semi-equipment, as you mentioned earlier, Carol, up as a group by 3.3%. Media and entertainment, of course, that's Take-Two Interactive and some of the gamers that at least have a good outlook. Mike, I want to know if you actually are a gamer. Is it World of Warcraft or is it more the Activision Blizzard games?
Checkers.
Which?
Checkers. I play checkers.
Oh, okay. So you're a Zynga guy. No, I'm just kidding. Energy index up 3.1%. We had obviously a huge rally in oil today as well, and that's obviously helping the energy majors. And as for decliners, as you say, really the defensive sectors, and they're not down as much as the winners are up.
All right, so let's get to it and some specific names in terms of the trading day. Skyworks Solutions, #1 in the S&P 500, finishing at its highs of the day, up 13.14%. The semiconductor makers' results led brokers to raise targets on the name. They noted that the update illustrated resilience during an industry's downturn, helped by its lower exposure to China and Samsung. This stock now up about 35%, and this is as the company came out and the guidance for the second quarter fell short of estimates. Analysts, though, are hopeful that a rebound is in the cards for later on in the year. Take-Two, Vonnie mentioned it. This is #4, I believe, in the S&P 500, but among your top gainers, finishing with almost an 8% gain in the session. The video game company embarked on a cost reduction program that caught the attention of investors. This is intended to save more than $50 million annually. The company also cut its net bookings forecast for the full year. Analysts say the lack of new titles are keeping gamers like Mike and others who are being more selective about their purchases at bay. All right, Zoom, check it out. Zoom Video Communications, #1 in the NASDAQ 100, cutting 1,300 jobs. We've heard this story before. It's about 15% of the global workforce. They put that out in a blog post. The CEO, Eric Yuan, calling himself accountable for the company's issues and said he will reduce his salary, also forego his bonus. Stock is up about 24% year to date. I said we've heard this story before because, Mike, it does feel like a company comes out, cuts workers, lays off some workers, and the stock rallies.
Yeah, unfortunately, it's all about those margins this year. But Carol, I'm so glad I get to talk about your favorite stock in the world, Bed Bath & Beyond. Now, you would think announcing that you were able to raise $1 billion to fend off bankruptcy would be good news for a stock. Not so much in the upside-down world of the meme stock era. Now, granted, Bed Bath & Beyond, those shares were up 92% yesterday, down 49% today after this announcement of that it'll be selling preferred securities and warrants to basically fend off bankruptcy. But I'll give you a hint at how volatile this stock is. It closed on Friday at $3.05. It's at 301 today, so nothing to see if you look at the weekly chart. Another downer, Carrier Global, that's the big heating, ventilation, and air conditioning company. They're down about 4% today. The results did match estimates, but both its earnings and sales were lower year over year. Also, the company said it sees free cash flow that's a little bit below analysts' estimates for the full year. Then again, this is a stock that had started off very strong this year. It was up as much as 14% year to date by February 2nd, so giving back a little of that gain today. Also on the downside, Simon Property Group, the real estate investment trust, that stock's down about 2%. Fell a lot more earlier, but came back, rebounded a little bit with the rest of the market. This comes after its 2023 funds from operations per share forecast missed the average analyst estimate. Mizuho analysts saying that multiple expansion is relatively limited given the lack of growth for this company, as well as all sorts of macro headlines, the things we've talked about all the time, creating like weakening consumer, higher interest rates, and tepid pricing.
You know, it's interesting. Outside of Bed Bath & Beyond, some of the biggest movers, well, actually, they're gainers. And I think that's a really big kind of take on what today is, because the volatility story in the stock market is not the same volatility story you're seeing in the bond market. Check this out. Yields higher for most of the curve. You are seeing this on, of course, the 2-year all the way out to the 10 and 30-year-olds as well. And this is important, Carol, because it came after we saw a big move. So the intraday volatility coming somewhere, I want to say 6-7 basis points off my rough math here, but we're looking at a 2-year yield that is at 447, a 5-year at 384, and a 10-year yield at 368. The biggest move you're seeing on the curve is only 4 basis points, Carol. So really nothing to write home about when we're talking about the bond market.
Yeah, it's going to be interesting to see. You know, now we have to go, just like the Fed chair and the Fed overall, data dependent, right? So each of those data points, each inflation reading, these are going to be really important, because I think as Jay Powell and all the members of the Fed, they continually remind us that we're sticking to that 2%, you know, global inflation target, if you will. They're not deviating away from it. So that means, Mike, they've got more work to do.
Yeah, and not a lot on the calendar tomorrow, Carol, to really move the needle, at least from a macroeconomic standpoint. We do have wholesale inventories month over month will be coming out at 10 o'clock. Also have the mortgage applications at 7. But, you know, we're kind of in that vacuum period, Vani, where there's just not a lot of macro information to trade on. So it's really, you know, check out all the earnings coming up and listen to every Fed speaker that comes down the pike.
We do have some Fed speakers. It'll be interesting to see how the market reacts to them, having reacted the way it did to Fed Chair Powell today. Just want to point out, VF Corp has now actually come out with its earnings. We did get a full year forecast yesterday that sent the stock lower. You can see now in the after hours it's down another 6%. It beat estimates on revenue, but just barely. And third quarter adjusted estimates from continuing operations came in at 112. The estimate was 99 cents. Full year revenue about plus 3%, so I guess people were hoping for something a little bit better. Its full year adjusted earnings forecast is definitely missing what it had seen, 205 to 215. It had seen $2 to 220. So on the upper end of that scale, it's really pulling back expectations. Of course, this is the maker of Vans and the North Face and Supreme.
Yeah, absolutely. And as you mentioned, Vonnie, the VF Corp down more than 5% in the aftermarket. Not seeing shares of H&R Block really move much here in the aftermarket, but this company has been on a tear in 2021, 2022. What it did come out and say is that its fiscal year 2023 outlook, they are reaffirming that. As for second quarter adjusted loss on shares continuing operations, $1.37. That's a little bit better than what the street was looking for. They were looking for an estimated loss of $1.48. Second quarter adjusted EBITDA loss continuing operations, $246.3 million. That too was better. The estimated loss was $258.3 million. But again, not seeing the stock move, but it's up about 7% Creedy so far this year. It's not just about tax preparations. They've been expanding the business over the last couple of years. It's a 5-year program, really trying to reach out to small business and more services, if you will, for the underserved financial community. But nonetheless, key headline is they are reaffirming their outlook for 2023. Stock still unchanged in the after hours.
Yeah, Carol, we are getting some headlines as well from Bed Bath & Beyond, which I'm told is your favorite stock.
You can't escape that company these days.
I always get lost when I go in.
Mike was talking about that record drop at the close, down about 49%. Well, we are getting more headlines after the bell that seem to be boosting the shares after hours to the tune of about 3%. This time coming as they aim to close about 360 Bed Bath & Beyond stores, as well as completing their equity offering, their public equity offering, excuse me. The offering does proceed to immediately repay that ABL facility, and the default under their credit pact has been waived. So perhaps a little bit of a sigh of relief when it comes to Bed Bath & Beyond.
All right, shares of Bed Bath & Beyond, as you said, up about 3%. Vertex also out with an update and announcing a new $3 billion stock buyback. That stock's down about 2.8% in the aftermarket. All right, guys, that's a wrap. Our cross-platform coverage, some earnings, and closing up the markets on this Fed Day. I'm calling it a Jay Powell Fed Day. Beyond the Bell, our cross-platform on radio, TV, on YouTube, and also on Bloomberg Originals. We will see you again, same time, same place, tomorrow.
When you say bud, it means you want the beer that's got a taste that's number one. When you say bud, you tell the world you know what makes it all the way.
All right, you know what that is, right? You watch the Super Bowl and you know what's always kind of a staple when it comes to the commercials is Budweiser, and that's an old Budweiser commercial. Does that ring familiar to you?
I haven't heard that one. Do you recognize that one?
It's an old, right, Paul, it's an old one. 70s. Yeah, that's an old one, Paul. It's going back a little bit. All right, well, the big game is this weekend. Will it be the Eagles? Will it be the Chiefs that take home the Lombardi Trophy? Time will tell, but already a winner is Fox, which sold out of its in-game ads, some topping $7 million. With more on it, let's get to Bloomberg News media reporter Jerry Smith here in our Bloomberg Interactive Brokers studio. Good to have you here with Mike and myself. That sounds pretty optimistic, pretty nice.
Yeah, there was a lot of uncertainty, obviously, coming into this Super Bowl with the economy. We've seen a lot of advertisers pull back their budgets, but that certainly didn't dissuade a lot of advertisers from spending on the Super Bowl.
Yeah, it is funny, right? Because on the mobile, the social, we've all been worried about advertising, but not for the big game here.
Yeah, I mean, it's the power of live sports, and advertisers are still willing to pay upwards of $7 million for a 30-second ad because this is the largest TV event of the year. You're talking about getting your brand in front of over 100 million people. People watch the commercials for the Super Bowl, unlike a lot of other types of programs.
Crazy. I'm like, don't go fast forward. I want
Right.
to watch them.
I got to say, as a lifelong Philadelphia Eagles fan, just this conversation alone is making me anxious. I was trying to pretend this game actually wasn't.
Try yoga breathing. It'll help. It'll help.
But Jerry, is that what it's all about? The fact that the Super Bowl's the one thing you can't fast forward or watch on demand. That this live advertising. This is sort of the last bastion for live advertisers to really make their statement.
Yeah, if you look at it, I mean, one of the craziest stats you'll see is last year over the top 100 most watched shows on TV. I think 94 of them were sports.
Wow.
And the vast majority of those were NFL games. So, you think about your dramas and your comedies and how they've increasingly moved from cable to streaming services. Live sports is still, is still really dominant.
Yeah.
It's expensive, though, right, for everybody who wants to air it.
It's expensive for everyone involved. I mean, the advertisers, certainly for the Super Bowl, are paying top dollar. These TV networks are spending an enormous amount of money acquiring the rights to these games. The entire cable TV industry really depends on live sports. A lot of the people who still subscribe to cable, who are not the cord cutters, are watching sports. So, if these TV networks, the day that an Amazon or an Apple years from now starts taking exclusive rights to some of these big events and more people cut the cord, the whole industry is really going to be, it's almost like a dominoes.
I want to go back to the ads in a moment, but let's just stay here with the sports rights because, we are increasingly seeing the streaming companies, pay up or want to have those exclusive sports rights. Or will it be exclusive at some point, or will it be where they show it, networks show it? Like, is it going to the point where streaming has it only?
I think we're years away from that. I think
Okay.
the NFL is the best example where the NFL did deals with the big TV networks, the NBC, CBS, Fox, ESPN, and so they have the rights for the next decade. But they also did a deal with Amazon where Amazon had the exclusive rights to Thursday Night Football. So if you think about some other sports, the NBA now is in the process of renegotiating their deal. Currently, it's on TNT and ESPN. Could potentially an Amazon or an Apple get some of those games? That's a really big question in the sports media industry. And for the average consumer, I think you're looking at a future where you have to have cable and you have to have multiple streaming services if you want to be able to watch all the sports that you want to see.
Yeah, and Jerry, obviously last year, the crypto ads were the big buzz. I'm assuming not so much this year, but is there any sort of growth industry that, pops out as buying a lot of ads this year? I remember back in the .com day, there's always the funny E-Trade ads and stuff like that. Is there something to take that crypto place?
Yeah, I think what's really interesting is that this is going to be the first time in more than 3 decades that you're going to see Super Bowl ads from alcohol brands that are not Anheuser-Busch InBev. It was really interesting to find out that they had the exclusive rights to be the alcohol brand for the Super Bowl since 1989. They gave up those rights in June. So now you're going to see ads from Molson Coors, which owns Miller Lite and Coors Light. You're going to see ads for Crown Royal whiskey. So you're starting to see more and more alcohol ads this year.
No other alcohol that ever was shown? I'm trying to remember.
That's in a national Super Bowl ad. There was they had Anheuser-Busch, and they're famous for their ads for the Super Bowl. You think about the Clydesdales, you think about the frogs. I mean, they're classics, but they were, they had the exclusive rights to be the exclusive alcohol brand, and that's over now. So you're going to see more alcohol brands. You're certainly not going to see as many crypto ads as we did last year when there were so many of them. People called it the Crypto Bowl.
No Tom Brady?
No, yeah,
crypto.
But I think you're
Too
going to,
soon, too
and
soon.
I also think you'll see a lot of the same players that you see year after year. The Doritos ad, the Pepsi ads.
Yeah.
You're going to see a ton of celebrities, which is pretty standard.
And it always seems like the creative departments behind these ads are at their peak, creativity for these ads. A few have come out already. Have any catch your eye as especially entertaining so far?
Yeah, I mean, this is, if you're a creative, if you're an advertising agency, this is your big moment. One thing that is particularly interesting is this idea of live betting. There's a lot of sports books that are, DraftKings and FanDuel have ads. And one thing that's particularly interesting is Rob Gronkowski, who was a tight end in his playing career. He's now retired. He's going to be attempting to kick a field goal live during the third quarter during a commercial for FanDuel. This is part of this marketing campaign that they've had going for several weeks.
And you can bet on it?
You can bet on whether he makes the kick or not, and it's live. It's not a taped commercial. It's happening live. So that's kind of an innovative way, to do it. There's you're going to see a lot of these partnerships. One is Netflix and General Motors, where you're going to have Will Ferrell. He's going to be appearing in episodes of Bridgerton or Squid Game, and he's going to be driving electric vehicles of General Motors, and that's an interesting partnership. So that's another thing that I've noticed is just these companies that are teaming up in their commercials.
We're gonna check in actually with the CEO of Hotel Planner in a moment and talk about lining up a hotel if you still want to head to the big game. Travel companies, not so much this year.
That's right. I think you're going to see fewer travel companies, and I think that's a sign of the times where people are dealing with inflation, and people are just have less money to spend on travel. I think you're going to see fewer auto commercials than you have in the past. Those can be for various reasons. But yeah, it's going to be Fox. As much as people, there's a lot of concern about advertisers pulling back their budgets. Fox said that they didn't see that much of that. The Super Bowl still dominates the media landscape, and advertisers are still willing to pay a lot of money to be seen on there.
I'd hate to be the poor MIT grad at DraftKings or FanDuel that has to set the money line on Gronk hitting that field goal. What do you think, Carol? Think he'll make it?
I don't know.
Let's place a bet.
That's not really his forte, is it?
I want to say it's like a 25-yard field goal, and he's been training with, for weeks with Adam Vinatieri. So, I mean, who knows?
You might get the job with Dallas after that. Who knows?
Oh my God, Paul Brennan's like, M&M and the Spokes Candies, are they going to make an appearance? Do we know? They pulled those Spokes Candies, and we were all trying to figure out, is it a Super Bowl campaign?
That's a good question. I mean, what's interesting is that almost all of the commercials are released weeks in advance or days in advance online, and the idea is to try and drum up as much conversation as you can about your brand. But there are a few companies that are advertising that are going to be surprises. So I guess we just have to watch and tune in.
Yeah, remember like when Mr. Peanut, rest in peace? And
That's right, but it was all of a farce.
It's a fun part of the game, and we'll all be watching. Jerry, thank you so much. Jerry Smith, he's media reporter at Bloomberg News here in our Interactive Brokers studio. Find him on Twitter at Jerry F. Smith. All right, you are listening and watching Bloomberg Business Week, and this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pelletan. We check the markets all day long at Bloomberg. Getting word from Bed Bath & Beyond says it has initiated incremental store closures in its Bed Bath & Beyond banner, with an ultimate operating goal of about 360 stores. So the store closings being announced at Bed Bath & Beyond. Lots of earnings after the close of trading. Among some of the names reporting, Chipotle Mexican Grill. That stock trading lower after hours. Chipotle reported comparable sales for the fourth quarter that missed the average analyst estimate. Right now, the stock is down 4.60%, but Chipotle's board did approve an additional buyback of up to $200 million. It also sees 2023 new restaurants in the range of 255 to 285. Estimates were for 274. So a lot to sort through in the earnings report out of Chipotle, but again, after hours, that stock now down by about 4.5%. It was an up day on Wall Street. Stocks closed very close to session highs. The S&P was up 53 points today, a gain of about 1.3%. Dow Industrials up 265, up 0.8%. NASDAQ was up 226 points. That was a gain today of about 1.9%. Turns out that Fed Chair Jay Powell's comments, which you heard here on Bloomberg, they were less aggressive than feared by investors. 10-year yield, 3.67% with the 2-year, 4.46%. Spot gold today up 0.2%, little changed, up $3.78 the ounce to $18.71. A big move though for crude oil today. West Texas Intermediate crude up 4.3%, $77.32 a barrel. I'm Charlie Pelletan. That is a Bloomberg Business Flash.
All right, Charlie, appreciate that update. Well, the big game, as you know, we just talked about it with our Jerry Smith about the ads during the Super Bowl. But if you're thinking maybe about heading to Arizona to watch it or maybe be there for the surrounding festivities, our next guest may have some thoughts on exactly how to do it and find some space to hang out in. Tim Henschel is co-founder and CEO of HotelPlanner.com, joins us via Zoom from London. Tim, nice to have you here with Mike Regan and myself. Let's just start big broadly, especially on a day when we just heard from Fed Chair Jay Powell. The travel environment, how does it look to you?
Travel's strong. You see in January, travel tech stocks were rebounding nicely, and we can say that we are looking at another year of 100% year-over-year growth out of COVID. So yeah, 2023 so far is starting really strong for travel. Yeah, we're happy about that.
Yeah, Tim, let's say hypothetically I am a football fan and I just landed a ticket to the Super Bowl. How out of luck am I when it comes to finding a hotel room right now? Is it still possible?
Well, every year we have this conversation. As you know, our company looks at rate compression in all big events around the globe. And the NFL, big Super Bowl, gets bigger every year. And unfortunately, they keep picking these like Glendale that only have 1,800 rooms. And of course, it's a small suburb of Phoenix. Phoenix only has 62,000 rooms. And every year, the number of people attending the Super Bowl, gets a little bit higher. And in LA, they just had 150,000 last year. Wow. So that's probably going to increase by another 5%. So you're talking about getting close to 160,000. And, there's only room capacity for 63,000 room nights. So, I'm sure your listeners can do the math. That means high hotel room prices. Especially
so does that mean there's
Phoenix is in season.
Tim,
too.
does that mean there's
go ahead.
actually rooms available? You're just going to have to pay up for it?
There's a few rooms still available, but for a star, you're looking at paying over $1,000 a night. So I think most people are opting now to look at VRBO or Airbnbs where you are going to pay more than a 3-star, but you'll get a house or a couple bedroom condo, and those are going for around $1,500 to $2,000 a night. But people are opting in that direction because that's where there's more availability than hotels.
Tim, I've heard that often hotels will oversell their rooms for an event like this. I mean, is it possible someone could arrive at their hotel and be turned away?
Oh, quite definitely. So what happens is when before the NFL announces the Super Bowl date, they have to lock out about 80% of the room inventory in the city. So they fill those rooms with corporate sponsor, with obviously the teams, families, and then over time, as they fill everybody who need in the city, they start releasing those rooms back to the general public. And so over time, you see more and more rooms. So even at the last minute, if a couple of important VIPs, hopefully no players, end up not making it, then those rooms get replaced. And so you could still pick something up, but of course, it's going to be thousands and thousands of dollars a night. But considering the minimum Super Bowl ticket is around $6,000 right now, if you want it that bad, what's paying a couple $1,000s a night for a hotel room as well?
That's right. I think I'll be camping out in the parking lot if I get a ticket, Carol. I don't know.
I understand.
I just think that the NFL needs to look at taking it to cities that are off season. Detroit could use a bit of demand right now, or Minneapolis, or Baltimore. To pick Phoenix, which in February it's in season, and there's a PGA event happening over the same time that doesn't even have that much room inventory. Just asking for people to be scrambling. But of course, if you're the NFL, you get your first pick of the prime hotel rooms. The fans can fend themselves, sort of thing, I guess.
Yeah, I guess it's maybe some issues you want to take up with the NFL. I'm going to go out a little bit more broader and bigger in terms of the travel world. Tell us a little bit about your company and why is it different, or why should a user go to you versus Trip or Expedia or Trivago?
Well, we're actually celebrating our 20th year anniversary, so we've been around for quite a while. The name hotel planner is synonymous with group, so think meeting planner, event planner before hotels. So that's why we follow compression over big events. So we actually power most of the large, what we call OTAs, online travel agencies that you just named, for 9+ rooms, 5+ rooms, anytime it becomes a bigger group. We also specialize in a gig call center that's global and localized. That's part of the service that helps us do large and small groups. So we also do individual in a closed user group environment. So these are rates that can't be published. So there's deeper discounts. So we have a lot of different niches in this market. Let's just say that make it unique.
So Tim, help me out. So if I wanted a room, because it does sound like, right, as you say, you guys are known for closed user group discount rates. So if I'm an individual but wants a room somewhere, can I get it, or do I have to be part of a group?
No, as an individual, you could get it. We just can only publish on the website for individuals the rates that are available to the general public. So to get those closed user group rates, either have to be behind a membership gateway, or you'll have to call us up, and our agents can help you over the phone with those.
Yeah, Tim, and I wonder for sort of your more routine travel needs, if there's any rules of thumb you could share with us about how to get the best deal. I mean, is there some room to haggle on those listed prices that we see? If I pick up the phone and get the right person on the other line, is it worth that effort, or is what I'm seeing on my screen the absolute best?
So most rates are yielded by what we call a revenue manager at the hotel, and some of those revenue managers are on bigger properties, but for smaller properties, they'll be clustered, and so you can't get a rate unless you're communicating with a revenue manager. With some cases, you do have owner operators, and that would be typically your general manager, and of course, they are an owner, they can give you any rate you want, but it's tough in touch with them, and there's nothing to say that they would actually do that. But everything's to try, especially once you get to the rates that are as high as they are now. The tough thing is, what they published online to sell is what they want, because they know they can get it because it's Super Bowl. But yeah, it's always worth a call.
But what about
get to the right person? It's just talking to that person.
Tim, what about general, not just the Super Bowl? I mean, I know when I go, and if I especially work travel, if I get into a hotel at 8 or 9 o'clock at night, I'm like, can you give me a better room? Can you do something on the rate? And you do often get a a better room or a better rate. Because I
Well,
just find this
especially if you
negotiating.
flash the Bloomberg card. I definitely agree. Media always gets treated very well. 'cause they
I don't know
you have
that's
a big
media
voice.
or maybe the corporate thing, but even when I travel for myself, I will say, can you do anything better on the room or something? Like I am not bashful. So should we as consumers just ask, as you say, the manager at a hotel or the front desk manager can do a lot. Just got about 20, 25 seconds left.
Yeah, no, absolutely. And sometimes be gracious and even ask to pay. Is there room upgrade available? I'd be willing to pay a little bit. And sometimes they'll just say, no, I can put you in a nicer room. No problem. And sometimes they'll say, oh, yeah, it's $25, $50 extra to upgrade to this room category. And more and more hotels are making the front desk, giving them that power. So, yeah, it's always worth an ask. And, call around for sure.
Something tells me, Tim, that they're going to charge the Eagles fans more regardless. Maybe charge them a security deposit. I don't know. I got a bad feeling.
All right, Tim, thank you so much. Tim Henschel, co-founder and chief executive officer of hotelplanner.com, joining us via Zoom from London. But I get his point about, other cities that could maybe use the boost from a Super Bowl
that's a great
game.
point. Absolutely.
But it always seems to go to warm venues. Miami, Arizona, I've seen it before. All right, right now, let's get back to world and national news. Nancy Lyons, she's in our nation's capital here with an update. Hey, Nance.
Thanks, Carol. President Biden is putting the finishing touches on his State of the Union address. The White House says he will highlight accomplishments from his first 2 years and chart a vision for the future. That includes a call for a minimum tax on billionaires and quadrupling the levy on stock buybacks. Terry Haynes, founder of Pangea Policy, tells Bloomberg those will not fly in a divided Congress.
He's going to focus on proposing things that are red meat for the base, like stock buybacks and the like, that won't get enacted, as opposed to things that might be enactable.
Terry Haynes with Pangea Policy. The president is also expected to address the war in Ukraine and police reform following the killing of Tyree Nichols. Well, the White House has put out First Lady Jill Biden's guest list for the State of the Union. Bloomberg's Nathan Hager has more.
The list includes Ukraine's ambassador to the U.S., the family of Tyree Nichols, former House Speaker Nancy Pelosi's husband, Paul, who's recovered from a violent attack inside his home, and the lead singer of U2, Bono. The White House says the more than dozen guests of the First Lady personify issues and policies that the president will bring up in his speech. Inviting the Nichols family suggests the president will call for action on police reform. Bono is being recognized for his work with PEPFAR, the global AIDS relief effort unveiled at the State of the Union 20 years ago by former President George W. Bush. In Washington, I'm Nathan Hager, Bloomberg Radio.
You can catch full coverage of the State of the Union on a special edition of Bloomberg's Balance of Power. It begins at 8:30 p.m. Wall Street time on Bloomberg Radio and Television. SpaceX founder and CEO Elon Musk wants to launch the company's Starship prototype into orbit next month. He tweeted the first orbital test of the vehicle would happen once a few remaining tests are completed. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. We have got shares of Chipotle Mexican Grill sinking in late trading after profitability and a key measure of sales fell short of Wall Street's expectations, showing that stubbornly high inflation is having an impact on the burrito chain's operations. Chipotle down by 3.1%. It was an update on Wall Street today. The Dow, the S&P, and NASDAQ all advanced. In fact, we closed at or near session highs. S&P was up 1.3%, gaining 53 points today. The Dow up 265, up by about 0.8%. NASDAQ up 226 points today, up by 1.9%. 10-year yield 3.67% with a 2-year at 4.46%. Spot gold up $4 the ounce to $18.71, up by about 0.2%. West Texas Intermediate crude oil up 4.5%, 77.45 a barrel on WTI. Stock traders bracing for Jay Powell to push back against the powerful rally that led to a loosening in financial conditions. Didn't get that today. The market found encouragement to move higher. Sarah Ponzek is financial advisor at UBS Private Wealth Management, and she was our guest right here on Bloomberg Business Week.
You know, when we look at the rally that we've seen this year, it's been unbelievable. It's really taken a lot of people by surprise and by storm as well. But entering into the year, positioning was pretty light. And what that means is when you have investors who are wrong-footed, who have tried to de-risk, and all of a sudden they see a market just storming higher, they get FOMO, fear of missing out, and they start chasing the rally, which seems to be a lot of what's happened this year.
And indeed, today we saw the rally with the S&P up 1.3%, up 53 points. The Dow up 0.8%, NASDAQ up 1.9%. 10-year yield 3.67%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week, brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Your small to medium-sized business could qualify for up to $26,000 per employee if you kept them on payroll during the pandemic. It's simple and easy to see if you qualify. Learn more at getrefunds.com. So, as you know, Mike, you know Valentine's Day is next week.
Whoops. It is?
I bet your wife knows. Well, that day, along with Mother's Day, are two of the biggest for the flower industry, which is why we wanted to check in once again with Christina Stembel, founder and CEO of Farm Girl Flowers. She joins us in our Bloomberg Interactive Broker studio, based on the West Coast, but here in New York. So great to have you here. How are you?
I'm good. Thanks for having me back. It's great to be in person this time.
It's so great. I mean, we've talked to you like throughout the pandemic. How does the world feel? Does it feel like we are over the pandemic hump? How's your world?
Sort of. I mean, I feel there's residual effects that are still like, impacting supply chain and transportation and things like that. But really, I think we're holding on to, getting as much money as you possibly can in those areas, and cost centers have not come down yet. So I think that'll normalize for the next 12 months.
Come down at all?
A little bit, but definitely not where we were hoping to see them. So I think that this next year is going to be really transformative that way and kind of normalize a little bit more.
You sound like Jay Powell. That's what he said. It's going to take maybe, well, he was saying like 2024.
Medium to moderate amount of time before.
Yeah. Well, maybe it's wishful thinking, but
I hear you.
And, Christine, it's funny. I'm here. I'm a father, a husband, father of 3 girls. So I've got certain occasions where I buy flowers, right? One's when I get in trouble, obviously,
Yes.
So
we love reading those cards.
Quite a bit. The other is Valentine's Day, and the other was, those daddy-daughter dances that all got canceled during the pandemic. So I missed your visit during the pandemic days. How bad was it? Did you lose a lot of suppliers? I mean, I feel like the flower industry especially must have been really hard hit.
Yeah, it was. We actually benefited, though, I have to say, and I felt a little schmarmy even saying that early on. I mean, the gifting segment in general, and we were definitely in that space, really benefited from the pandemic because everybody was sending gifts instead of being in person. But that came with
flowers.
Yeah, thank you. But what that did was it created, we all had to build infrastructures that we couldn't support later on. So, in 2020, we, turned off marketing and, for 10.5 months, we just turned it off. And we still did 100% growth.
Wow.
And then 2021 came, and I always said, oh no, when vaccines become readily available, I don't know what's going to happen. I know something big is going to happen, but I don't know how big it's going to be. And we just built this infrastructure, that we couldn't support any longer. And so then we had to rethink everything and be like, oh, now we have to right size the business, which is like the dreaded word, right? And so then we had to do that. And then, last year everybody thought, okay, it's over. And I was like, can't wait till 2022. It's finally going to be over. No, not over. Nope. So then, we have like transportation costs that are like, all the ancillary fees on top of ancillary fees on top of ancillary fees. And we have like containers that can't get there and, flowers that can't get there on time. And flowers, the number one thing, you have to get them there quickly. And so not being able to get them there quickly, we had 1 month where like over half of our orders weren't delivered on time. And it resulted in like $5.5 million of losses. And I mean, things like that. It was just constant. And so this year we're like, now we're in a down economy. And I'm like, oh my gosh, is this ever going to really end? I don't know.
How's it feel
see.
to own a business?
It feels great. Everybody should do it.
Well, I'll say, when you're a husband in trouble, those delays are no good. I guess.
Yeah, you need it like tomorrow. You need it like yesterday, really, for that. Right?
Christina, go back to some of the inflationary pressures, because this is something we talked with a person in the trucking industry. We're trying to really get a good feel. We've talked with chefs, and while things have come down, they do talk a lot about labor costs still are pretty high. You said they've come down a little bit, but it's still, your supply chain, it's still kind of expensive?
Yeah, I mean, we're at a size of a company that we don't have the buying power that a lot of large companies have. And so I'm sure that they're seeing it come down much quicker than companies, in the medium size, small, medium companies are just really, the last ones to see those savings. Because we can't go and say, like, we have, $200 million of buying power, and go to the transportation companies that way. But, so it's coming, but then it's also being offset by higher labor costs and things like that. So it's just, we want to be able to show our customers and have our customers realize these savings. And every time we think we're going to be able to lower our prices, again, it's not. Then it's just, we're dipping into our margins again.
Can you find all the workers you need and want?
No, absolutely not. So, we've been very creative about how we do that, with partnerships with farms that are drop shipping for us and things like that. It's just, it's really hard. Wage level employee, labor is really hard in the United States right now.
Does it feel like we're at the beginning of a down economy? You mentioned, you're prepping for a down economy. Is it starting to feel like that for you, for your business?
It's felt that way for a while now.
Yeah.
I think we've, I definitely think that we've been there for a while, and nobody wants to actually call a spade a spade.
Because demand is less?
Yeah, demand is far less.
Wow.
Demand is far less. I mean, we're discretionary. I mean, like flowers are not a necessity. Even, food in the gifting space, chocolates, stuff like that, feel like more of a necessity even than flowers. I kind of agree with that. I think, the sweets and things, but we're just, we benefited at times where where it was, gifts were sent a lot, and then when the economy goes down, people kind of tighten their belts a bit, and things like flowers don't seem as much of a necessity. And the great thing is we're a bootstrap company, and we spend less than we make.
You've done it all alone.
Yes, absolutely. And so we'll get through it. I'm 100% sure we'll get through it. Unlike some companies that I'm really feeling for that are reliant on raising capital right now, and money is really expensive and things like that. We've always done it this way, and so we'll get through it. But it's going to be tough. It's going to be another tough year.
Well, in terms of then growth plans, what do? Do you put things on hold?
We really change our focus. So, and I started this early, and I'm really glad that I did, and it panned out. Sometimes it doesn't. But, I switched our focus from growth to profitability. And I did that seeing what was coming ahead of us.
Were you not profitable before?
We always had to be profitable to a point. Like,
okay.
It's the thing that I say, the only way that we're like Amazon is that we ran as close to zero as possible, and then reinvest the profits back into the company. So there were many times where we're like, 1% profit and things like that. There's a lot of sleepless nights before payroll for me in the last 12 years.
Yeah.
So we really focused on having more of a cushion, and I'm glad we did that. And so we did things that actually cut our revenue, and we knew it would cut our revenue, but it made us financially just healthier as a company. And so we're going through this with that mentality of we're not growth at all costs. We are really maintaining a healthy stance in where we want to be.
Well, I have to say what I love about you, and we have some flowers, and I think our producer Ariel took a picture for those who are watching on YouTube and on our streaming service. It's just organic, and it's just beautiful. 20 seconds left. Valentine's Day, we can still order?
Yes, absolutely. Mike, get your order.
I got it right now.
Yes.
I know. Now.
Yes, get your orders. We're still taking orders right now, so go to farmgirlflowers.com to place yours now.
We love flowers. Christina, thank you so much. Good luck. Look forward to catching up with you in the future. feature. Christina Stempel, founder and CEO of Farm Girl Flowers. You can find them on Twitter at Farm Girl Flowers. And you are listening to Bloomberg Business Week. Carol Masser along with Mike Regan. And this is Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
It is 4:53 on Wall Street. We check the markets for you all day long here on Bloomberg. Chipotle Mexican Grill shares, they are sinking in late trading after profitability and a key measure of sales fell short of Wall Street expectations. Chipotle down by 4.5%. Our Steve Rappaport will have more coming up on Chipotle's earnings. See an ad for food on TV and you've got to have it right now. DoorDash and the streaming platform Roku are teaming up to allow viewers to order meals and snacks from ads. And with more on that story, here's Bloomberg's Denise Pellegrini.
Charlie, under this new deal, restaurants will be able to run interactive ads directly on Roku. And the streaming service says this deal lets advertisers find a household and user that's no longer on traditional TV. Also, these streamers apparently like to relax around mealtime. 1 in 3 users use takeout or food delivery once a week or more. And Roku users will also get a 6-month DoorDash membership for free. And Wendy's will be the first DoorDash brand partner offering special discounts. And this Roku DoorDash deal, we should point out, also being strategically announced just before Super Bowl Sunday. Charlie.
And that's Denise Pellegrini reporting Roku shares up today by 0.5%. DoorDash up by about 0.6%. Microsoft unveiling a version of its Bing Internet search engine powered by the newest technology from ChatGPT maker OpenAI. Microsoft today up by 4.2%. Job cuts at Boeing plans to trim about 2,000 finance and HR jobs. Boeing up by 3.8%. Those are some of the company stories we're following. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, more Business Week to come in just a moment. First up, though, a check on world and national news with Nancy Lyons in our 99.1 newsroom in D.C. Hey, Nance.
Thanks, Carol. Search and rescue crews from overseas are deploying in Turkey a day after a pair of powerful earthquakes killed more than 7,000 people. The EU's Joseph Borrell commends those who have rushed to the scene to help.
We have to remember the victims and the brave rescue workers who are still working around the clock to find survivors.
EU High Commissioner Joseph Borrell. Turkey's defense ministry says the military has started evacuating some of the injured via Navy ships. Millions are suffering without power or heat in the bitter cold. President Biden will be delivering his State of the Union address tonight against the backdrop of two big issues. Tensions with China are rising, and there is a brewing showdown with House Republicans over raising the debt limit. The president is expected to highlight the accomplishments of his first 2 years in office and also lay out his vision for the future. He will also outline a 4-part unity agenda, areas where both parties can come together on things like cancer cures and veteran support. The House Oversight Committee is looking at the Biden administration's handling of the Mexican border with testimony today from Chief Border Patrol agents from Arizona and Texas. Bloomberg's Irv Chapman reports.
Chairman James Comer opened the hearing.
President Biden and his administration have created the worst border crisis in American history.
Agent John Modlin described how well-organized smuggling cartels employ quasi-military tactics to bring in groups of young single men.
No one crosses the border in Tucson sector without going through the cartels. Everything south of the border is controlled by the cartels.
Committee Democrats noted that their last spending bill added 300 Border Patrol agents, and they urged Republicans to support immigration reform. In Washington, Irv Chapman, Bloomberg Radio.
Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Mike.
All right, Nance, thank you so much. Well, Bloomberg Radio and Bloomberg TV will have complete coverage of the State of the Union address beginning at 8:30 p.m. Wall Street time tonight. And with a preview, we have our own Joe Matthew, host of Bloomberg Sound On. And Joe, wondering, is it going to be a victory lap type of speech, or we have lots to do kind of speech, or we have lots of problems type of address, or all of the above?
The good news is it's long enough for it to be all of those things. And I've been suggesting, and I'll probably do it again before the end of the night, that wouldn't it be just an incredible moment? You'd talk about it on your program tomorrow. It would go viral online if he walked in and did it in less than 20 minutes. Drop the mic. I made all of my points. I'm going home now. Go to bed. It would be the most famous State of the Union in modern history.
It's not going
to happen. No, it's not going to happen.
If only, Joe, if only. Joe, you know, I was reading some of the notions that leaked from the speech, especially some of the more market-centric ones, like the increasing the tax on buybacks.
Yeah.
Any chance of that getting through Congress in this polarized atmosphere we're in?
No.
Yeah.
That's and we're done. And, you know, honestly, anything that appears to be new, and of course that's not new, along with the billionaires tax, that have come up a lot of times, Build Back Better, the infrastructure. This has been suggested to pay for a lot of things since President Biden has been in office, and it's just going to be, they haven't obviously gone anywhere, which is why we're still talking about it. And this House wouldn't let this happen. There's really not an appetite for it, but he's got a lot of progressives in the room, and we're going to have one of them coming up on Sound On, Maxine Waters.